Kia ora tātou and welcome to day 2 of the New Zealand Economics Forum, hosted by the University of Waikato and Te Raupapa, the Waikato Management School. Of course, we're waking to news today, very sad news out of Europe, that it looks like there is war in the Ukraine. We touched on that yesterday, and of course I suspect it will be a theme during today's conversations. We've had a long discussion yesterday, a long day for those watching online, but a lot of fantastic presenters, so thanks again to all that presented yesterday. And we've got a very strong session this morning. We'll be joined here soon by Reserve Bank Governor Adrian Orr. Of course, monetary policy very much in the spotlight. He'll be speaking at about 8:45. Following him, we'll have an expert panel on monetary policy, so that's going to be an interesting back-to-back session. We'll then have a session on fiscal policy, again looking forward to that and the interplay between them. We'll take a brief break at 11, then we'll go into a perennial favourite in the New Zealand economic scene of housing and infrastructure, before our last panel on globalisation, which has taken on new significance, of course, with the events over the last weeks and particularly overnight. To start us off for the day, before we're joined by the Reserve Bank Governor, I'm going to welcome Professor Frank Scrimger, a distinguished Professor of Economics here at the University of Waikato, and also Head of our School of Accounting, Finance and Economics. I'll pass over to you, Frank. Welcome.
Thank you, Matt. Tēnā koutou katoa. May I add my welcome to this second day of the forum. It is a great opportunity for us as we build on the depth of analysis and see how the different parts of our conversation fit together. As we move into this day, I'd like to remind you of the famous saying of that economist and educator Alan Blinder, that we need hard heads and soft hearts if we are to really address the major challenges of our age. I'd also remind you of Nobel laureate James Buchanan, who reminded us that we need to address the big questions and get those fundamentally right, and spend less of our time focusing on specific levers or real-world observations or complicated econometric models if we are to make progress. However, we do need to use these skills, but we do need more than good attitudes and kindly aspirations. Action, analysis, execution, planning and persuasion, increased understanding. Making progress in all of these areas requires us to have engaging conversations. And so this event today, it's a point in time when we can grapple with these important issues, which we must grapple with, but we are part of a longer term conversation. And I believe that what we're doing today builds on the legacy of Brian Philpott and Brian Easton, who've spent a lifetime trying to enhance the economic literacy of this nation. And so now it is our opportunity to participate. Yesterday we heard from academics and officials. We heard from business people and labour representatives. We heard from retired politicians. We have more of the same today, joined by bank economists and others. But the challenge for us is to engage, to listen, to put the difficult questions on Slido, to, if you like, to suck the juice out of the orange and spit out the pips so that we might make progress. We have this conversation, as I said, as part of history, and history hits us in various forms. We've watched emerging destruction in Europe overnight, and it's a reminder to us all that we need to listen and speak and listen again, and then act with focus and integrity. I welcome you all to your participation today, and I personally am enthusiastic to hear your voices. So back to you, Matt. Thank you.
Kia ora, Frank. Thanks for that. Right, without any further ado, I would like to welcome the Governor of the Reserve Bank, Adrian Orr, back to the New Zealand Economic Forum. It was great to have you here in person last year, Adrian, at your old university. No doubt brought back some memories, and hopefully next year back in person again. But in the meantime, looking forward to your talk today. I'm sure it will be keenly watched, given other statements earlier in the week. We'll hand over to you. For those watching online, please do get questions through on Slido. I'll receive those here in the studio, and after Adrian's speech, we'll have the chance to put some questions to him. Kia ora, Adrian, over to you.
Kia ora ana tātou, katoa toa, tēnā koutou katoa, and thank you, Matt, thank you, Waikato University, for this opportunity, and welcome everyone, and I look forward to your questions. So today we're putting a speech out on the record, so the good news is you can put your notes down, you'll be able to read what I've had to say in the comfort of your own homes. And yes, I do look forward to being there in person, and I strongly believe that will be the case for this time next year. So central banks around the world are currently confronted with a significant challenge, and it's a challenge we haven't seen for some time, but it is a challenge we're familiar with, and that is rising inflation pressures. The unfamiliar part really is the environment within which we are tackling this inflation challenge. These environments are always unique, and the world is always uncertain. So this morning I really just want to touch on the context that we made our monetary policy decisions in, particularly over this week, and also some of the challenges, both the ones we have faced and we face ahead, and in particular the unique aspects of these challenges for monetary policy. So without doubt, the COVID-19 pandemic provided really a unique setting for many central banks. We had to meet our low and stable consumer price inflation goals, really in the context of a unique and emerging health economic shock throughout the world. In early 2020, there were some really challenging factors facing policymakers, economic policymakers globally. The economic outlook, and hence any optimal policy response, became very dependent on the scale and the severity of the COVID-19 virus. This scale and severity, in the meanwhile, became dependent on a host of factors, how individuals, households, governments and central banks would react to the pandemic environment, the pace at which a vaccine would be developed and how effective that vaccine would be, and how quick it could actually be rolled out internationally. And of course, how the virus would evolve over time. So we're still amongst this at the moment, but they were very unique and uncertain challenges for us. Epidemiologists throughout the world struggled to model and predict the path of the virus, but these predictions played a considerable role in how governments and central banks developed any appropriate economic policy response. From the outset of the shock, we made it very clear here at the Reserve Bank and through our Monetary Policy Committee that any search for economic certainty was futile, and instead we needed to provide as much monetary policy certainty as possible within that uncertain economic environment. This is why we adopted a least regrets framework for deciding on our actions, and we continue to do so today. And by this, we mean ensuring that we avoid the worst policy mistakes while maximising our ability to continue to meet our objectives over the medium term. In early 2020, the risks to the global economy were heavily skewed to the downside. It was an incredibly biased outlook to the downside for inflation and for economic growth and employment. Governments had deliberately restricted economic and social activity so as to control, as best as possible, the spread of the COVID-19 virus. People also acted to protect their own personal health and well-being first and foremost. New Zealand faced a very material threat of experiencing a prolonged period of below-target consumer price inflation and employment levels well below any measure of maximum sustainable levels. The situation that we most wanted to avoid was one where inflation and economic activity and employment became persistently depressed. We were especially concerned about the scarring impact on New Zealand's economic capability as business investment came to a halt, and to avoid high unemployment becoming persistent through time. So obviously our path of least regrets was to move very quickly to ease monetary conditions and to take other steps to bolster what I would call cash flow and confidence throughout the economy through this initial wave of uncertainty. A unique challenge was, of course, that we entered this period, like many central banks around the world, with nominal interest rates very near their effective lower bound. By that I mean where the official cash rate, any further reductions in the official cash rate become ineffective in bringing forward spending activity. I mentioned this was the case globally, and it followed after a very long period of low and stable inflation and declining global real interest rates. So it meant that the committee, like many other peer central banks, needed to supplement our official cash rate policy tool with additional forms of monetary policy easing. Our aim was to further lower long-term interest rates below what we could achieve with the official cash rate. Fortunately for us, we had been preparing for these types of situations prior to the COVID-19 outbreak, and so we were able to operate and work pretty quickly in the face of this shock. We responded to the COVID-19 shock initially by lowering the official cash rate by 75 basis points, so we took it down to as what we would consider its then effective lower bound, and we implemented additional monetary policy tools, and this included the large-scale asset purchase program and the funding for lending program. Our monetary stimulus over time was thankfully accompanied by significant government spending and investment, fiscal support, including transfer payments, and this was incredibly important given some of the specific supply-side nature of this economic shock. The government's response in the end turned out to be one of the largest across the OECD, across advanced economies. And it was very welcomed, again, I should say, from the Monetary Policy Committee. The combined health and economic policy response of New Zealand has to date been ranked as one of the most effective across a wide range of countries. I will point you towards some recent work that David Skilling, a New Zealand economist, has produced a simple hybrid index of economic health measures and economic outcome measures, and it puts New Zealand, at the top, towards the top end of the nation's global response, with the massive caveat that the pandemic is not over yet, of course. The Reserve Bank's monetary policy response, looking ahead. So, that was the early stages, and then more recently, and looking ahead, our policy response is always going to be based on achieving our mandate. We set our policy responses on the information we have to date in hand, our assessment of how we think the economy best works, and of course, retaining optionality around being able to evolve policy through time and be resilient to any unanticipated future economic shocks. We are, of course, aware that monetary policy can only provide a temporary buffer to any economic shock, and really it's by bringing forward household spending and investment or delaying household spending and investment. So, we understand that our impact on the real economic activity is primarily temporary. As more information has become available and we've had time to observe how our economy and the global economic outlook has evolved, our policy response has evolved. In aggregate, we've been very pleased with how remarkably resilient the economy has remained in face of such high uncertainty and economic and social restrictions. We managed to avoid the worst scenarios of embedded deflation and unemployment, but we now face a more traditional challenge of constraining consumer price inflation, but still within this unique context of this COVID-19 pandemic. We're now sure that employment is above its maximum sustainable level, and we are very sure that inflation is too high. And this is occurring, of course, this challenge for us is occurring at a time when New Zealand is now experiencing its first widespread outbreak of the Omicron virus. To a significant extent, the recent increases in the consumer price inflation have been driven by global disruptions that have caused very sharp upward price pressures in the economy, in particular for critical commodities, but a broad range of imported goods and services. I've just referred to the events that are ongoing at the moment in Europe. That's just another example of how commodity prices can spike. We've seen in our oil prices well north of US $100 per barrel. So these prices are things that monetary policy can do nothing about, particularly New Zealand's monetary policy. In the decade prior to the pandemic, all of this imported consumer price inflation into New Zealand was actually putting a downward pressure on overall CPI inflation. We had these deflationary tradables price pressures, and they make up a very large proportion, around 40% of New Zealand's total consumer price index basket, and they acted as an anchor to total headline inflation. Meanwhile, domestic-driven consumer price inflation, the non-tradables inflation, averaged more than 2% per annum over these years. So headline CPI inflation was being constrained by below-average tradables inflation and above midpoint non-tradables inflation. Downward pressure on prices from global competition and technology progress has, at least for now, abated. This has resulted from the pandemic-induced shocks to changes in demand patterns, for example, from services to goods, the ongoing supply disruptions that are everywhere, and the reduced mobility of goods, services, and labour. What it means is that we can no longer rely on declining price pressures from these internationally traded goods and services. And central banks globally are grappling with exactly this challenge. New Zealand's monetary policy, of course, has no direct influence on these imported global prices, other than perhaps indirectly through our exchange rate. And even then, that relationship is far from certain. The global nature of the economic shock really has meant that exchange rates have been incredibly stable over recent times. The whole world experienced this COVID-19 shock at the same time, and it means there has been very little relative work for exchange rates to do, adjusting to the shocks. And in fact, over recent months, what we've seen is that global interest rate differentials have narrowed, as other central banks have moved towards more of the tightening horizon that we have, and we've seen the New Zealand trade-weighted index exchange rate decline, and it's currently down around 7, if not slightly higher percent, down around 7 to 8% from its pre-pandemic level. The most notable driver of inflation pressures has been, in terms of New Zealand, has been oil prices. But I will say that that tradable inflation is far more widespread than just oil prices. The global economy continues to struggle to supply sufficient goods and services to meet the strong ongoing demand. There's both a catch-up from demand running ahead of the supply, and there's also continued ongoing supply into the future. So the degree of inflationary pressures experienced across economies has, to some extent, very much depended on the different starting points for economies as they headed into the economic pandemic. We do have to remember that most of our advanced economy trading partners had experienced for a very long time very low and subdued inflation and persistently high unemployment. In fact, it was only until recently the central banks of Japan, the United States, the Euro area, Australia, and less so here in New Zealand, were all increasingly concerned about undershooting their inflation targets rather than overshooting. And obviously, this has since been tipped on its head by this pandemic. Central banks are now signalling and undertaking policy tightening. These policy responses do vary across countries based on the starting points for inflation, for output gaps, for employment, but they're all heading in the same direction around reducing stimulus and starting to tighten monetary policy. Enough about what's gone on internationally, around which we have limited influence, if any. Back here at home, domestic inflation pressures have also been rising, and this is an important reason why the committee has responded recently with tightening policy, and why we continue to have to expect to do so until we know that our inflation expectations are well anchored and we will have consumer price inflation back within our target range. In one sense, this is business as usual. New Zealand has a long history of bringing inflation down, as does the rest of the world. Where we have a shorter history is working out how to bring domestic inflation back up. So we're using our tried and trusted monetary policy approach, and that's to ensure that inflation comes back into its target. And of course, we have to do this without causing undue volatility in interest rates, the exchange rate, and output and employment itself. Again, this is our mandate. It's our business as usual. Our path of least regrets has now become one where we must ensure that consumer price inflation and inflation expectations do not rise persistently above our target level. And I think anything less risks long-term economic costs and reduced well-being for all New Zealanders. I suppose to highlight our resolve to meet our remit, it's useful to compare our actions globally. Amongst many of our central bank peers, we were one of the first to begin removing monetary stimulus and start this tightening cycle. We ceased our quantitative easing activities in mid last year, July 2021, and this was by ending the purchase of our purchases of government bonds. And over the remainder of 2021 and until recently, we have now lifted the official cash rate 3 times, so by 75 basis points. Importantly, we've also signalled there's more to come, and we have talked a lot about where we believe the neutral nominal interest rate is and how far we may need to go above neutral to achieve our inflation targets. So really the idea is we're taking our foot off the accelerator as quickly as possible to avoid having to use the brake unnecessarily in the future to maintain our inflation mandate. So that's all strictly central banking tasks, nothing particularly unique or unusual globally, more unique and unusual historically. Some of the challenges that we've had to face through all of this have been, have provided great lessons, and we'll talk about how we're going to try and capture these lessons and work with everyone on this call in the near future. One real interesting challenge was the immense government fiscal support that occurred internationally. It was very timely, it was well received and necessary. The level of that fiscal support in response to the pandemic was much larger than we've seen in any recent shocks, and that was both in timeliness and scale. In New Zealand, fiscal support for bolstering aggregate demand was very welcomed by the Monetary Policy Committee, given the size and the pace of the shock we were dealing with, given the ongoing low nominal interest rate environments, and given some of the very specific supply side effects of the health response that were undertaken globally and, of course, here in New Zealand. We do acknowledge now, though, that the bulk of the fiscal impulse is behind us. The government's response to the COVID-19 pandemic was very strong over 2020, 2021, and looking ahead, it's becoming more business as usual for fiscal policy. The Treasury's current outlook suggests that fiscal policy is expected to be less stimulatory for aggregate demand in terms of impulse, and hence add less upward pressure on spending or potential inflation in the economy. The committee's ongoing challenge, of course, is to ensure that inflation remains low and stable through this period, and that the fiscal policy can go about its longer-term activities. And I understand you all heard from Carolee McLeish yesterday, which was a very clear articulation of their challenges. While fiscal policy has been an incredibly important tool for this aggregate demand management, I would say that monetary policy will need to be stepping back up more into the front line over the period ahead, as it remains the most effective tool for stabilising economic activity through business cycles. And this is largely due to the ease and frequency with which we can adjust policy, our operational independence, which is critical to enabling us to go about our business, and of course these potential significant economic costs of dynamically adjusting government spending, taxes and transfers to cyclical behaviours. Of course, we will need to continue to observe ongoing fiscal decisions, and our monetary policy actions will ensure that any implications of fiscal spending or fiscal policy, taxes, spending, welfare transfers, and of course policies around border opening, labour mobility and other things that impact on the supply side of the economy. These are all critical inputs into setting our monetary policy decisions. I do want to emphasise, of course, that there is no simple rule of thumb between fiscal spending and an inflation outcome, or government decisions and an inflation outcome. It's going to always depend on the impacts of supply to the economy, what's happening to the long-term productive capacity, any implications for demand, and of course any offsetting implications for what it may mean for private sector investment or spending decisions. So there's no simple rule of thumb. It's all about the nature of the spending, the nature of the tax changes, and the nature of the regulatory environment that ultimately depend on an optimal monetary policy response. Another real challenge for us, and one that has been very high profile and will continue to be, really is the role that monetary policy has played with regard to asset prices and asset price volatility. In New Zealand, this has been most evident and most talked about through residential house prices. Like high consumer price inflation, the rapid rise in asset price inflation has been a global phenomenon. But the increase in New Zealand house prices has been exceptional and well above global averages. And it's taken New Zealand house prices, what I would say is well above a sustainable level. By sustainable, what we can explain just through traditional supply and demand type modelling. Our research shows that it is the persistent decline in global nominal interest rates that most affect asset prices, whereas changes in New Zealand's official cash rate relative to the global rate has a much smaller effect. And we've been observing this global secular decline in interest rates for at least a couple of decades, driven by that low global stable inflation, a long period of very low inflation, and structural factors that I know this audience knows well. Demographic issues, productivity issues, all things that affect the level of expected real economic growth in the long term. A key reason why lower global interest rates have had such a significant impact on house prices in New Zealand really has been the lack of supply of housing itself. Land use restrictions and other constraints on building have restrained the supply of land and hence housing. I do note, though, that this trend has recently turned. Building consents are at a record level, and this is at a time when the population growth through 2021 was just less than half of 1%, its lowest level since 1988. And mortgage interest rates are now rising, and there is tighter access to credit. We're now confronted with thinking about how asset prices will react to this rising interest rate environment, and how homeowners might react to declining household balance sheet worth. I will reiterate that house prices have remained at a very high level, and I will note that household balance sheets and corporate balance sheets are in a very strong position. But it will feel different if house prices start to decline, and we're seeing aggregate household balance sheets being impacted already through their KiwiSaver accounts and other financial investments as the global economy, as asset prices respond internationally to rising interest rates. We also recognise that monetary policy has distributional impacts, including through the housing markets. Our research has shown that monetary policy easing and tightenings can affect the distribution of wealth and income through multiple channels. But our mandate is very humble and appropriate. It recognises the limitations that monetary policy has on influencing these distributional effects. The best impact monetary policy can have is reflected in our mandate, and that is through maintaining low and stable inflation and doing so in a manner that contributes to maximum sustainable employment. Of course, Te Pūtea Mātua, the Reserve Bank of New Zealand, is what we call a full-service central bank, and we have responsibilities for both monetary and financial stability purposes. Our purpose for responding to any unsustainable asset price movements is really to ensure that the broad financial stability is maintained. We would love to ensure that both borrowers and lenders are able to manage their financial risks through good times and bad, and that any specific issues to the otherwise do not lead to broad financial instability. So to manage some of the cyclical drivers of financial instability, we have been deploying over the recent decades an increasing suite of macro-prudential tools. Since the onset of this pandemic, we have been active in using these tools, particularly the key tool around our loan-to-value ratio restrictions. At the onset of the pandemic crisis, we removed our LVR restrictions, loan-to-value ratio restrictions, and that was so that we could be confident that monetary policy would be its most effective, that that banks were able to have full use of their balance sheet to bring forward spending and investment. By early 2021, we were in a much more certain position, and we were able to see how the pandemic was evolving, and we were confident enough to put restrictions back on put our LVRs back in place, and in fact tighten them in a means of heading off any undue financial risk and high leverage, particularly for people entering the housing market in recent times. So that will always remain an important and active part of not just monetary policy, but macroprudential tools to assist cyclical challenges the economy faces. Another real challenge for us was both, and the broader bank, of course, and the fiscal authorities, was in the design, the implementation, the calibration, and the explanation of our additional monetary policy tools. In particular, on the explanation front, a significant challenge was this persistent singling out of the new tools as the cause of house price inflation. But as we all know, causation and correlation are different concepts. The additional monetary policy tools that we utilised were simply there to assist lowering nominal interest rates across the yield curve. It was up to the financial institutions and individuals to decide how to utilise these lower interest rate environments. It was not simply a cash flow transfer from us into households to buy houses. It was about lowering interest rates. It was business as usual, albeit through additional tools. Our large-scale asset purchase program affects long-term interest rates really through this exchange of settlement accounts at the bank with retail banks for their bonds, and that puts downward pressure on bond yields and hence downward pressure on the yield curve and interest rates in the economy. The level of government bonds on offer is determined solely by the government, the fiscal authorities, not the Reserve Bank. Likewise, the amount of bonds the committee chose to buy depends solely on the committee's needs, not the fiscal needs of government. So monetary and fiscal policy remain separate, and the operational independence of the bank remains clear. Looking ahead, we are continually reviewing our work to improve the implementation and formulation of monetary policy. Our new legislation, which comes into work in July 1 of this year, actually requires us, which I think is a wonderful thing and consistent with what we see across other best practice central banks globally, it requires us every 5 years to do a thorough review of these monetary policy tools. And the idea is to ensure that we remain accountable, transparent, effective and capable to undertake the monetary policy remits. Our review process, it's now underway. We've kicked it off internally and we are about to go externally, and we are going to be encouraging, insisting that you all take part in assisting us work through this review. We're thinking about it in two legs. The first one is a backward-looking review and assessment of our policy performance over the last 5 years. And the other part is about formulating advice on the monetary policy remit for the Minister of Finance about what, if any, changes are needed going forward from these lessons. We are legally obliged through the legislation to have this advice in front of the Minister of Finance no later than towards the end of 2023. But this is going to be a project that we're undertaking. It will involve public consultation, and the first round of public consultation is in the middle of this calendar year. We're going to be looking at a lot of the structural changes that may have impacted on the remit and the operation of monetary policy, and the lessons of activities of recent years. So I encourage you to take part in this. It's really exciting to be involved, and it gives us a great opportunity for everyone to be able to contribute their thoughts. I'm going to finish up then just to say, look, what have I done? I've outlined the unique global context to monetary policy, some of the unique tools and contexts that we've operated in, I've acknowledged the role of asset prices and distributional impacts that monetary policy can have on these issues. And of course, I've put the pānui out and the flag up for the review of our monetary policy remit. Mai taki mai ata. I look forward to questions.
Kia ora, Alistair. Thank you. And the first reflection is just the degree to which you and your team have been in the hot seat over the last couple of years. Monetary policy has probably never had quite so many clicks on the mainstream media than in the last couple of years. Look, a lot of questions coming through over Slido, and please keep them coming through. I'm going to start with a bit of a nuts and bolts one. You've picked inflation coming back to more normal levels, we might call it, within target ranges, I believe, by mid-2023, which is sooner than some might have picked. And yet you're also looking at an official cash rate up above almost 3.5% out to 2025. So can you guide us through the committee's thinking on this and where we see, I guess, how long do we see inflation there? What gives you confidence that it's going to come back within bound, and yet you're looking at that higher OCR out, 3-4 years?
Wonderful. The first thing that gives me confidence that inflation will come back. I'm sorry, mate, you might need to go on mute. So the first thing that gives us confidence around the inflation is our policy remit and our operational independence. So, we can still have significant and effective influence over consumer price inflation within our monetary domain, and that's our task. Now, the second bit around what we have to do to achieve that, I think it's really important to remember where we're coming from is as important as to where we're going with the official cash rate. So we're coming from an extremely historically low nominal interest rate. And a lot of the work we're doing at the moment is simply getting us back to a neutral interest rate, and then we're saying we may need to be north of that for some time to be effective, i.e. slowly stepping on the brake. Neutral nominal interest rates, I can't believe I'm saying this, but we say around 2% nominal. That still feels incredibly low historically. And so, for a lot of people out there in the economy, this is, they're going, wow, interest rates are rising, but they're going from something very low to something at most quite average, and if not just marginally above average. So it's not quite as dramatic as it may feel, and that has been part of the warnings and discussions we've been trying to put out to people, that normal interest rates are well above where they are making their first borrowing decisions. The good news is that a lot of that rate rise that we are talking about with regard to the official cash rate is already priced in to those forward-looking curves, and in a large part being reflected out there in mortgage rate land. And we know that over half of all mortgages money that's out there at the moment is going to be reset over the course of this year. So there's a lot built in and a lot that will already happen. But we must follow through with what was said as well in order to bank that tightening that is priced in at the moment. With regard to the actual inflation, a significant part of shifting from where we expect to be peaking between 6.5%-7% first quarter of this year. I'm deliberately being quite loose on the first quarter CPI inflation because the swing variable, of course, is oil prices, and so this is the noise that happens in near-term inflation. Now, a lot of those are one-off price level shifts that even if they don't go back down, the mere fact they don't keep going up, you're going to see measured CPI inflation come off over the course of 2022 and into 23. We don't see headline CPI inflation getting below the 3%, just getting into our target range until next year, and being at the midpoint of our target range until the year after. So you can see we are still trying to ensure expectations remain anchored, but not be too dramatic to interest rates output the exchange rate. We're trying to focus on that horizon that we are most impactful on and do it in a credible, transparent manner.
Thank you. And thank you for the clarification. I'm going to go a little bit back into the days 2020, and I'm sure they were they'll stick in your memory. It must have been a sense of drama almost, certainly across the world, as everybody was figuring out how to respond to the situation and then maybe look forward. You've talked about the legislation requiring review. I think that's excellent. It's part of the long run of, you'd say, New Zealand's legislative tools around central banking, which have put us in a very strong position. When you go back into that period, when was it that the bank made the switch? And I guess all of the world, if you consider the economic consensus at the time around demand shock, and then of course we've said now actually it was more on the supply side. When did the bank start seeing that and start switching that view? Because of course many of us have gone through, and we all know a lot more now, so it's a lot easier 2020 hindsight. When did the bank start seeing this as more of a supply shock versus demand?
Yeah, so I would say right from the outset, we were very convinced it was going to be both a demand and a supply shock. But in our least regrets framework, and given that demand is immediate, supply takes time, we could see very strongly that the risks, even though it's both demand and supply, this will dominate, demand will dominate first, and we needed to dramatically reduce monetary conditions. We also had to dramatically reduce monetary conditions because being the only one standing there with higher than otherwise interest rates, etc., we would have had the exchange rate going through the roof. So part of it, so the immediate shock to demand and supply, demand wins the day, do that, and then let's see where the dust settles around what the supply capacity or constraints actually are in the future. When did we have confidence around the demand? Had stabilised, and when did the supply issues really start to become evident? That was more towards the end of, and I'm struggling to do it, more towards the end of 2020, and this is when we had said, don't expect a lot more. We are just maintaining monetary conditions at the slow level. We're not looking for additional things to do. And fiscal policy was the main show in town. We were actively trying to take monetary policy off the stage and say this is from here a fiscal policy show. And that was because of the more targeted nature that fiscal policy and general government policy could take on sectors of the economy, on supply side issues of the economy that monetary policy just had no effort over. And as economic resilience proved, both on the global side in particular and the holding up of commodity prices and our terms of trade holding up, and as we saw the wage support and businesses maintain, balance sheets maintain their strength through all of the unprecedented fiscal policy response, that gave us the confidence by mid-2021 that we could now start to exit this extraordinary monetary policy loosening period and start to renormalise in a manner. Now, remember, all of this is still being done in the environment of the ongoing rolling pandemic.
It's heady times without even factoring in the events in Europe overnight. So it might be a last question, given time constraints. We could go for hours. It's a theme again of what have we learned and also looking forward. You've touched on distributional impacts. I look at the banner behind you, wellbeing and prosperity for all New Zealanders, and I know that you have made that a central point of the bank's focus. Obviously, some are sitting out there saying this is the stimulus that was needed in the early days. This has had quite devastating impacts on those that might not get into the housing market. You have made very clear there are only so many levers the bank has. But thinking now, again, hindsight 2020, it's much easier. But with hindsight, and as you go into this review period, if we were to have another similar crisis, what have we learned from the early days of what we as a nation went through then? Or, as one of the questions came through, did we over-egg it? Did we overstimulate the economy in retrospect? And what might we do differently now? Which I say isn't necessarily a critique on where we were, because now we have more information. But what have we learned out of last time that we could apply next time?
Yeah, I would say first and foremost, build houses. This is the continuous challenge of wanting our cake and eating it too. Not in my backyard, not on my watch. I'm against it. challenges that are writ large globally, but especially strong in New Zealand. We had an unbelievable population growth and a very, very poor response around housing. I would be thinking hard around the lack of depth and breadth of our broader capital markets, which generally means that so much of our intermediation is done through reliance on housing as collateral and also housing as an investment tool. So those are much longer structural things. I'm not obfuscating from where the central bank is, but I actually think it's really small incremental improvements you would make around monetary policy relative to significant changes you can make outside of this institution. When you say whether have we under or over-egged it, well, core inflation is at the top end of our band, maximum employment is slightly above its maximum sustainable employment. I would say that's not a bad outcome to date, given from where we've been, and we're now still firmly in control of keeping inflation down. What did the committee most struggle with throughout? Getting line of sight and timeliness around fiscal policy responses. You think internationally fiscal policy had been told go away as an aggregate demand manager, yet globally fiscal policy appropriately immediately stepped up and became the most significant. We had no real experience in New Zealand of direct wage subsidies or business guarantee schemes, etc., around how that would support and bolster housing. So that ongoing connectedness of monetary and fiscal policy whilst retaining the operational independence is critical. Number one, and number two, the terrorists, Te Pūtea Mātua and the Treasury worked incredibly closely together. And so, but we can always think much harder. I would love the academic effort, capability in this audience to be thinking around that monetary fiscal policy response and how our supply side of our economy can be more flexible to ongoing shocks and innovation.
I see a whole branch of academic articles coming out on this period over the years ahead. I mean, it's been some heady times. Look, we're at the end of our time. Adrian, thank you so much for your time and for your team's time. We'll, of course, now have a panel on monetary policy, so we'll get other views coming in, and then a session on fiscal policy as well. There are a lot of questions on the interrelationship between those two, part of a longer conversation another time, I think. But for today, thank you again and wish you well. Kia ora until next time.
Kia ora. Thank you. All the best.
I'll pass back across now. We're going to go to our next panel. This is the panel on monetary policy, and it's going to be moderated by Stephen Joyce. So back across to you, Stephen.
Thanks very much, Matt. Very interesting comments there from the Reserve Bank Governor, Adrian Orr. And a couple of things he noted. I mean, there's the ongoing discussion about how much inflation is imported and how much of it is generated internally. He did note, and I certainly picked up, that we had I think he said, one of the biggest fiscal responses in the OECD, and also we've had one of the biggest house price increases in the OECD. In fact, around the world, is wider than the OECD, one of the biggest house prices increases over this period. So the question is the bank in the exact right space, which seems to be Adrian's view, which I suppose is understandable if you're the Reserve Bank Governor, or we should be doing something differently? And we now have three panellists who are able to help us with that discussion to no end. So we have firstly Sharon Zollner, who's the Chief Economist of our biggest bank, the ANZ Bank. We have Grant Spencer, former Deputy Reserve Bank Governor and acting Reserve Bank Governor when yours truly was Finance Minister, and also currently the Adjunct Professor in Economics and Finance at the Victoria University of Wellington. And live from London, and thank you very much, Charles, for giving us your time at this time of the evening in London, Professor Charles Goodhart, who's the Emeritus Professor of Banking and Finance at the London School of Economics. So a very illustrious panel. The plan is, team, that we don't do too long in the prepared comments. You know, you've heard me on this already. 5 to 7 minutes to lay out your stall as to what you think we are up to and what we should be doing, and then discussion for about the second half of our session. So Sharon, you've drawn the short straw, so you get to go first.
Thanks very much, and thanks for inviting me to be here again today. So I guess I'll step right back here. How did we get here? And I think there is an emerging consensus on what happened, and that is that when COVID hit, it was widely thought that it would be a rerun of the GFC to some extent, insofar as that it would be a big net negative, long-lasting hit to confidence and spending, and that therefore both monetary and fiscal policy should do everything they possibly could to shore up demand. And that while there were obviously consequences for the supply side of things, that those would be relatively short-lived and sort themselves out pretty quickly, because that's what capitalism is good at. However, what we've seen, of course, is the complete opposite, that with the very able support of both monetary and fiscal policy, what we had was a series of very short-lived demand shocks, whereas the hit to the supply capacity of the world and the ability to move goods around, all that sort of thing, has been extremely long-lasting and is showing no signs of getting better at all. It's still getting worse. And so, of course, that is a far, far more inflationary mix. And it's obviously problematic that policymakers got it wrong. They weren't alone in that, though. I mean, we were also waiting for the other shoe to drop, thinking, not believing our own business surveys. Businesses were telling us that we were in one heck of a V-shaped recovery. We're going, but we've had a national income shock. We're all poorer now. How can we possibly be all spending like we've won lotto? And yet that's exactly what happened. We had incredibly strong retail spending, underpinned by the very, very strong performance of the New Zealand housing market, with house prices up 40% since COVID hit, which is quite something. And of course, we now sit here with much higher government debt and higher household debt. Businesses, however, have been pretty prudent. So they're not quite in the same boat as some countries where every sector has leveraged up. But nonetheless, we are sitting with a heavier debt load than we had before, and much higher asset prices. So in New Zealand, it's mostly about housing, but this has, of course, been a global phenomenon. So whether you're talking about equities or Bitcoin or some of the more obscure cryptocurrencies or non-fungible tokens, people paying $1,000 or more for the ownership of an anime picture, which is this different from this other one that's for sale for $10,000. You know, people are buying investments that they don't understand even necessarily what they are or what they're for or what the risks are around them. That has definitely been a theme of the last couple of years. It was emerging before that, but obviously the easing in monetary conditions, the massive surge of liquidity really did put the fire under that. We've been here before and it didn't end well. And so I think there does need to be some kind of reckoning in some pockets of asset markets where risk has been severely mispriced for a very long time. And of course, the party's been able to continue as long as central banks are your friends. But central banks are now backed into quite the corner. You know, US inflation's already 7%. New Zealand inflation could well end up there, given what's happening to oil prices now. And so in that situation, there is really only one mandate that counts. Everything else is a nice to have. And so with supply shocks, there are unpleasant trade-offs that central banks have not had to face for a very long time in terms of stabilising employment and output versus stabilising inflation. So you can see that in the forecast. The Reserve Bank is forecasting raising the official cash rate steadily as house prices fall. So that's unprecedented. And so the question is, you know, having had this boom globally, can we now solve this inflation problem without a bust? Is there a forward path for the official cash rate that will bring inflation back to target in an acceptable time frame without causing a hard landing in the housing market and in the economy more broadly? Because obviously the housing market is extremely important for the New Zealand outlook. We're all forecasting exactly that. We're all forecasting a soft landing, that the Goldilocks scenario, I mean, it's still not great, but it's the best of a bad lot where the economy does struggle. We've got supply constraints, most obviously the supply of labour, but it really is across the board. Jib board would be another pressure point, but they're all over the economy. So we're going to struggle to deliver strong growth in that environment. We've got rising interest rates, falling house prices, 6% inflation is a massive cost of living impost on households. Now, that's not a great growth picture, but we've got the Reserve Bank raising rates throughout because that's the reality of what you get with a supply shock. Our forecast for a soft landing, that would be pretty much unprecedented, that central banks managed to beat 7% inflation without a recession somewhere in the mix. So perhaps that's a good segue to Grant Spencer to talk about what he thinks the Reserve Bank should be doing from this rather awkward starting point. Thank you.
Thank you very much, Sharon. There's lots of points there we will come back to. And you're right, we will go straight to Grant, who's in the interesting position of, after a long period of time at the bank, and now an observer of the bank, an observer of the monetary policy responses of central banks around the world. So, Grant. Thank you.
Well, thank you, Stephen, and thanks, Sharon. It's a pleasure to be here. I'll make 3 points. The first one is that I do think monetary policy has been easy for too long, and the Reserve Bank does need to move faster in this tightening cycle. Inflation's the highest it's been since 1990. It's across all the main CPI components. And so there is a real risk that inflation's going to become embedded in expectations and become very difficult and costly to remove down the track. And as Sharon mentioned, with the further pressure on oil prices, that's just going to make it even more difficult. Now, the bank, was, relatively speaking, an early mover with its first tightening in August last year, but it's still been slow. It's just been a bit faster than other central banks. It's expecting to still really have its foot on the accelerator up until the end of this year. In other words, it's not expecting to get back to neutral until the end of this year. So that's not a good place to be if you've got a really serious inflation problem brewing. You should be moving back to neutral more rapidly. That is what's going to reduce the regret of an embedded inflation problem. My second point is that if the bank does move more promptly, move faster, I think the overall tightening, the overall increase in the OCR in this cycle may not need to be huge, and it may not need to be as high as the terminal rate of 3.4% that the bank indicated on Wednesday. The fact is, some of these touched on by Sharon, is that, a very high level of debt at the starting point in the private sector, particularly in the household sector, so that any increase in OCR is going to quickly erode discretionary incomes. We've got the weakening housing sector, the housing market, and we know there are a raft of factors affecting housing apart from the higher interest rates. So that's going to reinforce the impact of the tightening policy. And thirdly, the synchronisation of global monetary policies. So, if the Reserve Bank actions are going with the global tide, they're going to be a lot more effective than when they're going against the tide. So, I feel that if the bank does move promptly, the terminal rate could stay between 2.5% to 3%, rather than being north of 3%. If you're getting north of 3%, that's the situation where you're going to have embedded inflation as a problem, and that risk of a hard landing that Sharon was talking about is going to be greater. The third point I wanted to make was around the unconventional monetary policies, quantitative easing, credit easing. So in our case, the LSAP program and the funding for lending program. In my view, they can have benefits in the short term, but bring significant risks and distortions the longer they're left in place. The main risk is that governments come to rely on monetary financing of their fiscal deficits. And the distortions is the undermining of the fundamental drivers of term interest rates, which are the demand and supply of loanable funds and expectations. So while these policies may be used in a crisis or an extreme situation, they should not become mainstream monetary policy tools. If we look at the LSAP, I think the bank has sensibly, winding that up. It called a halt in July last year, and on Wednesday it announced the total zeroing out of government bond holdings on the Reserve Bank balance sheet over 5 years. I think that's a reasonable approach, and so I would support that. On the other hand, with the Funding for Lending program, this program is in fact more interventionist than quantitative easing, because it's a subsidy, it's a lending subsidy, in this case to the banks. And when you're normalising policy, I would think that should be the first policy removed, not the last policy removed. And the bank has that not finishing up until December this year. So that remains a bit of a mystery to me. But my central point here is that the unconventional policies can be useful, but they should be seen more in the stabilisation, lender of last resort category, rather than being adopted as mainstream policies. So back to you, Stephen.
Thank you very much, Grant. We may come back on the Funding for Lending program and of course other elements of your comments as we proceed. To get the full picture, we're going to now take Charles Goodhart's view from London. Charles has been a friend of this country for a long, long time. He's had a relationship with the New Zealand Reserve Bank going back many years, and senior staff of the bank. And although it's fair to say in preparation for this, we've been giving him a quick, catch-up on current situations in this country, obviously probably helped by the last two speakers and their comments. So, Charles, with that in mind, we'd really appreciate your thoughts from a more international perspective.
Thank you very much. I'm very glad to talk to my various friends in New Zealand. I'd like to start by saying that the Governor is absolutely right when he says both that all central banks have really followed exactly the same kind of policies, facing the same kind of conditions, and that New Zealand is not unique in this respect in any way. And what is more, that the Reserve Bank was one of the very first to realize that there was a need to stop the massively expansionary monetary policies that all the central banks had followed. Nevertheless, I think that 2021 is going to come out as a year when all the central banks, including the RBNZ, actually got it wrong. And they got it wrong by not seeing the persistence and strength of the inflationary pressures that were getting in place. I could actually illustrate that by saying that one of the standard approaches to trying to decide what kind of interest rate was appropriate is the Taylor rule. And the Taylor rule says that you ought to raise interest rates, nominal interest rates, by more than the increase in inflation over the target level, and by the degree to which your unemployment is below the sustainable rate. Now, if you do that for New Zealand, I haven't actually done the figures exactly. My guess is that what you would get would be that the Taylor rule would suggest an interest rate of somewhere between 6 and 7%. In other words, double the sort of 3.4 that people have been talking about as the neutral rate. Well, okay, this is because there's been a supply shock, and it's oil prices and it's supply shocks and this, that, and the other. But I am reminded very much of how we got into the stagflation conditions in the 1970s. There was an oil shock in the 1970s after the Arab-Israeli war, when some of you who are older like me will remember that oil prices doubled, quadrupled, went up 4 times, a much percentage higher increase than we're likely to see now. And a lot of countries and a lot of monetary central banks thought that because this was temporary, you should look through it. The problem with that is that when you get a sufficient increase in prices, that it actually reduces people's living standards and they don't like it. And if the labor market is strong enough, they will seek and demand higher wages in line. And there was a difference between countries which had tried to absorb the Arab-Israeli oil shock, like the UK and Italy, which got into an inflation price spiral, and Germany, which said, well, we mustn't accept this because we have got to keep the demand down so that we don't hit a wage price spiral. Now, again, you're talking about the decline in housing prices. But when you've got inflation rising faster than the rate at which nominal interests are going up, real rates are going down, and people will think that actually the cost of borrowing in real terms isn't rising yet very much. Okay, so that rises in nominal interest rates will have an effect, even if real rates are still very low and for the time being declining. And given what's been happening to oil prices and gas prices and will happen to wheat prices and food prices and fertilizer prices, the likelihood that inflation will rise even further over the next 3 months is almost baked in. And rising nominal interest rates at 25% when inflation is probably going to be rising at 50 basis points a month is not what you might describe as particularly strong. Finally, the governor and sort of the general consensus was, okay, we're going to go back to neutral. Well, Alan Blinder is just writing a book looking at how the Fed tried to deal with inflationary spikes over the years since 1965. And in most cases, not all, but in almost every case, you actually needed interest rates well above neutral, and you had to have possibly a short recession in order to bring the inflation spike back, even if the initial cause of the inflation spike appears to be simply temporary, because you cannot allow a wage price spiral to develop. And the idea that people will go on believing in that inflation will come back to low levels if inflation goes on rising for a few quarters more is, I think, somewhat wishful thinking. Central banks are in a horribly difficult position. On the one hand, if they don't do enough, inflation will get embedded. On the other hand, if they do too much, anywhere, and that's not only New Zealand, it's anywhere in the world, we could have an asset price collapse leading to a recession, which will do no one any good. Trying to get a soft landing under these conditions is actually it's an analogy I didn't make myself, but I think it's rather a good one. It's like trying to land a 747 on the deck of an aircraft carrier. You know, one little slip either way, and you're in the soup, either inflationary soup or recessionary soup. I wish every central banker and those of the monetary committees the best of luck in an extraordinarily difficult situation. And I think they will need a hell of a lot of luck to get out of this without their reputations being in difficulty.
Thank you very much, Charles. And I think we should probably credit former Prime Minister Bill English with that, New Zealand former Prime Minister Bill English with that saying, because you and I discussed it earlier in the week and we agreed that it was quite a good one for the current scenario. Before we go back to the rest of the panel, I have a question for you. It's been head-scratching for me just how slow the Federal Reserve has been and just how little debate there was in the US beyond, I think, Larry Summers about the inflationary effect of the Biden stimulus package soon after he was elected. Are we in a situation where people have forgotten the lessons of history, and does that include the Federal Reserve, for example?
I think it does. People are really quite myopic. And expectations, you expect what you had in the recent past. They're not particularly good at looking forward. The idea that markets and sort of swaptions and options are a good predictor of what's going to happen in the future. The idea that the difference between index-linked and nominal bonds are a good predictor of what's going to happen in the future, that's for the birds. We can't foresee the future, and we have to be much more quickly adaptive to current conditions. And the belief that central banks have somehow credibly anchored inflation expectations and therefore everything will come back to normal, I'm afraid it's just wishful thinking.
I want to bring in the rest of the panel now, if I could. There's a great old saying which comes from, I think, the last inflationary period, is that monetary policy needs friends. And the question we have now is monetary policy being complemented by other government policies, or is there work to be done there? I think governments around the world are trying to sort of contract out all responsibility for inflation to their respective central banks. In the New Zealand context, we have Minister Robertson talking about further increases in spending in this year's budget. And we also have a government talking about further constraints, notwithstanding, of course, the very big constraint at the moment of COVID and the borders, but talking about tighter immigration policy going forward than it has been in the recent past. Are we in a situation where other government policies are going to make the Reserve Bank's job harder to achieve that Goldilocks landing, if you like? Let's start with Grant.
Thanks, Stephen. Yeah, well, those other policies are very important. I think from the point of view of fiscal policy per se, we heard Carolee yesterday, and so even though spending has increased and is staying at a high level, the actual fiscal impulse apparently is starting to come off. So the fiscal impulse, because the economy has been strong, the tax take has been great, the deficit hasn't been rising as fast as expected, that fiscal impulse is not a big counterweight to a tightening monetary policy. But, the other policies you mentioned, the sort of ones that affect the supply side, clearly housing supply is an important factor where the government is making some contribution there. And the other very important one that you just mentioned, migration, that clearly is going to play a major role in terms of these supply side pressures. So if you're looking to ease the supply side pressures, the freeing up of migration is probably the biggest factor, the biggest contribution they could make.
Okay. Sharon, what's your view? Should the government be tightening its fiscal response at this point?
Well, in a pure macroeconomic monetary policy friend perspective, probably yes. But one of the unfortunate consequences of this pandemic has been widening inequality. And so it's pretty difficult to say there isn't a role for government to try and address that. But then insofar as you're supporting incomes and trying to boost spending power, then you are working in exactly the opposite direction to monetary policy. But then you start getting into the question of, well, who is going to pay the price for solving inflation? Is it going to be businesses who find it harder to pass on price increases and wear it in their margins? Is it going to be minimum wage or low wage earners who don't get perhaps the wage increases that others might? Or is it going to be highly indebted recent home buyers? the choices that monetary and fiscal policy make will determine to some extent who wears the cost of that. And what we have seen, unfortunately, in the last 2 years is that those the more vulnerable members of society have worn quite a lot of it, and also the younger generation. They're the ones sitting there with the fiscal debt. They're the ones who have paid through the nose for houses, and so you have to take that into account as well. Unfortunately, they're not a very large voting bloc, and they seem to be a little bit apathetic about voting. But I do think that that's something as well that fiscal policy needs to take into account. But in a broader picture, we've got the big numbers, but we don't yet know what they're going to spend it on. And in such a capacity-constrained economy, I think that's going to matter a huge amount in terms of how much inflationary pressure it adds.
Charles, what would be your advice to the government of the day in probably any country, I suppose, in terms of where they should be going with their fiscal stance now and their other microeconomic regulatory policies? Because it feels to me we're still acting to some degree as if inflation is not the very significant problem that it is.
Well, again, New Zealand is not alone. It's not unique in any respect. On immigration, the population, and particularly the working age population of the UK and the US, would go down from here on if it wasn't for immigration. The only way that we're going to get an increased supply, particularly, and this is something as an old person I feel very strongly about, of care workers. The proportion of old in our societies is going to go up by leaps and bounds. It's not something that most people, at any rate in the UK, actually want to do. We don't get immigrants in to help us with it. We're going to have a crisis of lack of care of the old, and also a massive, great increase in wages for those carers. So on immigration policy, a lot of countries are going to have to struggle with this particular problem. It's not just New Zealand. It may well be that attitudes towards immigration of the countries at large will have to change actually quite dramatically. One of the other things that I would advocate is that prices of energy, petrol, gas, and so on are going to go way up. One of the things that I would suggest is that when these prices, as they will, start coming down, that you keep the domestic prices high in order to deal or help to deal with both climate change and the fiscal problem, both at the same time. So that I would hope that ministers of finance simply don't allow the subsequent decline in energy prices, which will come, to bring about a decline in CPI. Take the opportunity to raise taxes and keep pressure on reducing fossil fuel usage.
Okay. Folks, I want to move to the impact of ultra-loose monetary conditions on asset prices. And then, of course, the flip of that, which is the potential for a rapid downward trend in asset prices now. In the New Zealand context, as Sharon's pointed out, it's through the housing market more than anything else. Early on in the pandemic, the Governor Orr was making quite a virtue of the fact that one of the great things about ultra-loose monetary policy was people felt wealthier because their house price was going up and their asset prices were going up, and they could therefore feel confident about borrowing more. Earlier this week, he was distancing himself from that and saying, well, they should have been more careful, potentially, if interest rates are now going to go up. So sort of a little bit of having your cake and eating it too. But nevertheless, one of the things that strikes me is we've had a long discussion in this country about house supply and the impact of various factors on house prices. But certainly in recent times, it seems that no immigration, large numbers of housing consents and building going on, that we've really been driven a lot by low interest rates. That's pushed people to perhaps pay more than they would ever pay previously in the housing market. Have we got a problem here that as rates go up, get to 3.5% in the bank scenario, possibly more than that in Charles's scenario? I mean, how are people going to feel if the impact is less equity in housing and a drop in housing prices, about the whole monetary policy construct. I mean, this is a big deal, isn't it? Isn't there a political dimension to this in terms of the impact of particularly first home buyers? So I don't know who I'm going to throw the ball to first, but let's start with Grant on that, and then Sharon.
Well, you're right, Stephen. Housing, whether we like it or not, has been one of the main, and probably the main, transmission channels for monetary policy for many years. I'd say the other main one is the exchange rate, and both of them can cause problems from time to time. So, yeah, with the initial easing of policy, a lot of the impact was generated through increased wealth, increased house prices, increased wealth. People feel more confident, better off, and they go out and spend, and aggregate demand is boosted, and and the policy has effect. So all of those sort of side effects related to equity and difficulty for first home buyers, etc. But basically, the Reserve Bank sort of sidelined those and tries to play them down, even though they realise, they are real issues. They're unintended, distributional effects, for example. But monetary policy is not a perfect tool, and that's the way it has its greatest leverage. As you say, in the reverse scenario, now where we're headed down the other side, a lot of those effects are going to be unwound, and there's going to be a lot of discomfort for people, existing homeowners, but maybe some of the first potential first home buyers lining up, the younger people, may feel a little bit better that maybe housing is within reach after all.
Sharon, I'm conscious that you're in the sort of front line of this, given that you're the chief economist for New Zealand's largest bank. So I imagine you'll step carefully through this minefield. So what's your read, and should we be worried, probably as policymakers, if you think about this debate? I mean, one of the things I worry about is whether we take asset prices into consideration sufficiently in monetary policy decisions. So maybe we can go a bit broader.
Yeah, that is a thorny one because bubbles are hard to identify in real time. But I think there's a fundamental problem actually with the way monetary policy works, and that is that recessions are by their very nature unforecastable. They're basically a collective freak out, and that's a very unstable thing that you can never forecast. So therefore monetary policy isn't forced to take into account the consequences of its actions today on what the next recession looks like, because we know another recession is going to happen. There's always another recession. You don't know when it's going to happen. But in Norway, the central bank actually has as one of its objectives to lean into, to counteract the build-up of financial imbalances that might make the next recession worse. So, I mean, there are issues with that. How much should you lean? Doesn't that risk you setting interest rates higher than necessary sometimes? But it would at least force a discussion about what are we doing to the next recession, because the depth of a recession depends very, very much on the degree of silliness that preceded it, how bulletproof everybody felt. And we have definitely gone into the silly zone in the last 2 years, and we are going to pay that price in the next recession, which you will not find in our forecasts. You won't find it in the Reserve Bank's forecast. We're hopeless at seeing recessions coming, but we know they will come. And we know that the asset price appreciation we've had in the last 2 years is going to make that recession worse. Was it worth it? Did we even ask that question? The framework doesn't actually encourage central banks when they're setting policy to think about that bigger picture. It's all about maximising growth in the near term if it's currently too low. Obviously, we're in a different game now where they're trying to dampen growth, but yeah, we've overfilled the hole, and now I'm a little bit worried that we have actually unnecessarily exacerbated the business cycle, and how bad that's going to get, we don't know, but we are currently in quite a fragile situation.
Can I just make a comment there, a relevant comment, Chair?
Yeah.
is that, Sharon's point, in the Reserve Bank legislation, it does actually say that monetary policy shall have regard for financial stability. You know, there's the objective, financial stability objective, and there's the dual mandate. Now, you know, in that major easing that happened in early 2020, there was no mention of the having regard to financial stability. But, you know, this is something that central banks have to think about, and different governors and different central banks think about it in varying degrees. Some put more emphasis on the financial stability aspect, this you know, costs of generating extreme asset price movements. And if that had been given more weight in early 2020, you know, maybe that initial major easing would not have been so great when it started to become apparent that housing was going to really take off. I'll just put that in there, that there is that capacity in the framework.
The Governor talks a lot about the least regrets policy, and every time he says it, it worries me a little bit. It was sort of like, just go big and then go bigger and we'll worry about it later. That's how I interpreted it a little bit. Charles, can I bring you in? I mean, this is not the first time we've had a debate about asset price bubbles and loose monetary conditions. You have Alan Greenspan back in the 90s, and then they had the dot-com bubble. Here we are again, potentially. Do central banks, as a rule, take enough notice of the impact of their decisions on asset prices?
I think that you could suggest that they take too much concern, not all of the central banks, but the Fed in particular. As you mentioned, the Greenspan put, whenever asset prices in the US have gone down really sharply, the Fed has come back from any restrictive policies in order to ensure that asset prices don't collapse too much. And the very fact that financial markets are declining quite sharply after Putin's invasion means, I think, that at the next Fed FOMC, we are almost bound to get 25 basis points rather than 50 basis points, because they don't want to upset markets too much. Because they don't want to upset markets too much, not just out of interest for the markets as such, but if you upset markets too much, you can get a recession. There's always the fear of 1929 at the back of the minds of central bankers. And the very concern about asset markets being too frothy, and the likelihood is that from now on there's going to be quite a sharp decline, means that it's going to be very hard for the Fed and for anybody else, any other central bank, really to raise interest rates sufficiently fast to keep a wage price spiral from developing and getting going. And it's a very, very nasty situation. And you want to tell the markets, no, we're not going to support you. In which case, under present circumstances, you could have free fall in a recession. Or you effectively say, we're going to do things very gently and we're going to warn the markets every time we're going to move, that sort of thing. And then the likelihood that a wage price spiral will develop is actually quite high.
And aren't we at the point where this is that approach has got completely out of hand? I mean, look at the multiples of share prices on the US stock exchange, the NFT phenomenon, all the other things we could highlight from earlier this year. I think it was the takeaway joint that was worth a couple of $100 million. The whole thing feels like this has all gone a bit too far, doesn't it? And if the Federal Reserve is running scared of upsetting asset markets, then really effectively the Greenspan put continues, and we'll never get back to a more sort of sensible risk allocation matrix, if you like, he said, sounding slightly worried about these things. Sharon, any thoughts from you there?
You can suppress all evidence of risk for a surprisingly long time, but you cannot eliminate risk as a central bank. And so I think people for a long time have thought, oh, the central bank's got our backs, we're all good. But, you know, that risk, that volatility, it gets bottled up and then it explodes. So I don't doubt we're going to get back to a more sustainable and sensible valuation for assets. We may undershoot, but we'll get there because those market forces will not be denied forever. It just could be a bit of an uncomfortable path, as I think we're all on the same page on that one.
I sense that. I think I polled this panel on the likelihood of achieving a soft and gentle landing, it might not fare well with the three of you. Can I get one final word then on the Russia-Ukraine situation? Charles, you've already made the point about the risk of increased commodity prices further in some of the key commodities. Is there a chance, for example, will this make the current situation worse, you think, from a economic perspective? And of course, we're all very worried for the people of Ukraine, and there's a much bigger issue than the immediate sort of economic impacts, but here we are talking about macroeconomics. Or is there a risk actually that it sends the markets into a negative tailspin, which actually alleviates the inflation risk, or at least assists the central banks with the inflation risk? Again, not wishing ill on anybody.
I think the answer is that both are going to happen. Markets are already weakened. I think they're inevitably going to weaken further. But in the short run, this is a massive further adverse supply shock, which sends prices higher. The prices of fertilizer, for example, in the UK, are virtually tripled. You reduce massive wheat exports from Ukraine and Russia, and the prices of basic foodstuffs of flour are going to be shooting up over the next 6 months. I don't see how there's any alternative. And it just makes both the outlook and the problems of market weakness on the one hand and inflation getting out of hand on the other, that much worse. And it's bad news, however you look at it.
Grant and Sharon, particularly from a New Zealand perspective.
Well, it's a terrible event, and it will have significant short-term effects. But being sort of clinical about it from a sort of an historical perspective, if you look at the impact of wars on financial markets, often it can be quite a short, sharp sell-off. I don't have much doubt that the markets are selling off, but it's not major. Obviously, if it blew up into something really more serious and bringing in other countries, then that's a different picture. But the way it's looking now, I would see markets bouncing back. And even now, the market analysts focusing on really, what the Fed's going to do, whether it's going to be starting to adjust from 50 points back to 25 points, and focusing on the policy as opposed to this particular, geopolitical event in Europe.
Okay.
And just one point on the interest rates, in terms of those overvalued assets, that, in the recent cycle, the central banks of this world have contributed to zero and negative rates, so they've really exacerbated those elevated asset prices. But underlying that, over the past 20 years, has been a downward secular trend in real interest rates, which has been the underlying driver of the very strong asset prices over the past 10 years and longer. So, I just don't want to exaggerate or overstate the central bank's contribution to this. There are underlying real factors that are driving these markets as well.
Very fair point. Sharon, we'll let you have a final word on any of these topics.
Oh, there's so much to talk about. Obviously New Zealand doesn't have much direct trade exposure to Russia or Ukraine, but it does seem likely to boost world oil prices and energy more generally. And it's also hit the New Zealand dollar, so that all adds up to more pressure at the petrol pump. And the Reserve Bank basically said that increase in global inflation pressures was a big driver of why they thought the OCR needed to stay higher, because their framework basically assumes that has the potential to have a persistent impact on inflation expectations. And in this environment, it's very hard to disagree. So in that context, it definitely increases the chance of the Reserve Bank hiking by 50 at some meeting in the future if it persists, because it's going to boost headline inflation. But beyond the near term, it's symptomatic of a world where geopolitical risk is a growing threat, and I think that's going to contribute to a partial unwinding of the globalisation, which has been such a deflationary force in the last decade or two. And so I think it just does underpin that we're no longer in a world where inflation needs to be lovingly nurtured. We're in a world where it needs to be smacked on the head regularly, which is in a way back to normal, and not entirely bad in that sense. But we've got quite a problem on our hands for now, though, and I think we're all pretty much on the same page that that's going to be a very, very challenging environment for some time yet.
Look, thank you very much, all three of you, for your time. A sobering assessment, but also a very sensible assessment of where things are at. Charles, thank you very much for joining us from London, late in the evening there now, I know. We do appreciate your contribution, and also to Grant and Sharon, thank you very much for joining us on the Economic Forum today. Well, Matt, very interesting session, and taking the two together with Reserve Bank Governor Adrian Orr and this group, a lot to think about, a lot to talk about.
Huge. I think it's been a big morning already. Thank you to the panel, to Charles, Grant and to Sharon. There's a lot to consider on many different fronts, and it's particularly valuable, of course, having had the Governor and the expert panel back to back. What you would have picked up, of course, a theme right through the last couple of hours is the interplay between monetary and fiscal policy. So obviously the two are working in tandem. As somebody said, monetary policy needs friends. And that brings us into our next panel. Just a quick run through of how the rest of the morning is going to pan out before we wrap up the forum a little bit before 1 o'clock. So our next panel will be on fiscal policy, and I'll introduce that in just a moment. We'll then have a short break at about 11 for 15 minutes. After that, we'll come back with two other topics that have been discussed regularly. That's housing, that'll be at 11:15, and on to a panel on the global situation. That'll be at 12 noon. So all of these have been raised regularly during the morning, and I expect will continue to be a lot to consider. I'd like now to pass over to our panel on fiscal policy. This will be moderated by Professor Les Oxley, one of our team here at the Waikato Management School. So Les, over to you, and looking forward to another good discussion.
Morena, and welcome everyone to today's session this morning, looking at fiscal policy, alternatives and opportunities. My name's Les Oxley. I'm Professor of Economics at New Zealand's #1 business school, the Waikato Management School, Te Raupapa. And it's, I think, very opportune that the fiscal policy session follows what has been a very active monetary policy session, but also follows the discussion coming from Caroline McLeish, our opening session. And I'd like to stress that this particular session is looking at alternatives and opportunities for fiscal policy moving forward. And we heard last night from Jim Bolger a bit of a call for something different from us in terms of moving forward. He'd heard many of these things before and was throwing out the opportunity for us to produce something new. But also I've just heard in passing Charles Goodhart talking about an opportunity here for New Zealand to take the opportunity to increase taxes. So we have alternatives and opportunities available to us. We've got a wonderful panel here to help discuss and put their cases in terms of alternatives and opportunities. I'm going to give a very brief introduction. We have Mark Holmes, who's a professor of economics here at the Waikato Management School. Mark's expertise is in macro policy and also macro theory, but also has done a lot of work on housing, infrastructure, and other tax-related issues. We have Sir Robert MacLeod, who is chairperson of Sanford Quayside Holdings. He's got a long history in terms of his tax expertise, so he knows what has been done and has a equally strong reputation in terms of looking at issues related to Indigenous, in particular Maori issues, which I think we haven't really touched on apart from on the Maori business session that we had. And we have Oliver Hartwich, who is from the New Zealand Initiative. Oliver has a much more extensive track record than we have seen necessarily in New Zealand, coming from a background working in Sydney and advising, I noticed, the House of Lords in the UK, a very interesting advisory role. So without further ado, I'd like to call upon Mark Holmes to pitch his 5 to 7 minutes stall here and tell us about some opportunities and alternatives. Thank you, Mark.
Thank you, Les. Hello, everybody. I want to say a few things about fiscal policy alternatives and opportunities. Clearly, this is a big topic, and following on from the closing comments yesterday, this is one of those areas that could have occupied an entire forum within itself. But I want to just broach one or two issues related to the way forward that we might experience. So, as we're aware, there's been a deterioration in public finances, not just New Zealand, but elsewhere. And we have a degree of uncertainty over the future course of COVID. So, we're aware of the potential for stop-start economies, impact on business confidence, problematic international travel, so on and so forth. So from the point of view of fiscal policymakers, we have issues in terms of the volatility of revenue streams, challenges in terms of planning fiscal expenditure in the context of stabilisation policy. And against that, we have a background in terms of issues that include an ageing population and concerns over productivity growth. So what I see the opportunity here is in terms of a reflection on tax and spending policies. Once, if you like, a recovery is well underway from the COVID era, and it seems that the New Zealand government will need to start thinking about getting its fiscal position in order. But of course, a premature withdrawal of fiscal support or increased taxes could potentially undermine the recovery. So what I'm really going to touch upon is, what might happen post-COVID, and perhaps relating to an issue that was covered in the opening presentation yesterday in terms of prudent investment versus prudent debt. Do we need to be very careful about rolling things forward in that respect, or do we have a case for bringing public debt to income ratios back down to where they were previously? Now, if we look at the data, I've just delved into the OECD database before the talk, and it's clear that by the measures presented there, if we look at the budget deficit as a percentage of GDP, New Zealand sits relatively okay compared to other OECD countries that I've been looking at. Of course, as with other countries, there's been a deterioration there, but it seems to be in such a negative territory over time. And if we look at debt to income, which where debt is in part based on the accumulation of past deficits. We can see that NZ public debt to GDP, again, looks reasonably respectable compared to other OECD members and the OECD average. Okay, sure, there's been an increase in recent years, but it seems to be an issue that is not as high as some of the scary values that we've observed for other countries. So perhaps things don't look as uncomfortable as compared to elsewhere. So a question is whether New Zealand should aim to rapidly re-establish pre-pandemic levels of debt, or perhaps even pre-global financial crisis levels of debt, which saw a lower still debt to income ratio. Now, fiscal stabilization measures might still be related to pandemic issues over time. We don't really know how the situation is going to unfold. And as we're talking, of course, we have an ongoing major international crisis. And, we're cautious that this may too impact on future fiscal planning as well. But I wanted to think about another question that has come up in terms of prudent long-term infrastructure projects. And is there still the opportunity to invest in those projects at what are still low interest rates? And I'm thinking of health, education, transport. We still have our climate change obligations, of course, and whether we still have an opportunity to push forward on that. In a sense, if you think about the times going into better times post-COVID, does that free up an element of budgetary support that can provide resources that can be allocated elsewhere? Now, when we think about the debt to income ratio, we might think about sustainability of that. We see the New Zealand debt to income ratio increasing. We've had much lower values, now increasing above, say 50% of GDP. Is that a stable or unstable trajectory over time? So commentators might think about the real interest rate that's paid on debt and compare that to the growth rate of the economy. Okay, so comparison of, if you like, R and G, real interest rate, growth rate of the economy, might provide an approximate rule of thumb. Not a strict one, because there are many bells and whistles, many ifs and buts in drawing out the theory, but it might suggest that a higher debt to income ratio may still be sustainable if the real interest rate is relatively lower. But of course, we now observe interest rates going up. Obviously, we have developments this week in New Zealand. US Fed next month almost certainly will increase interest rates, I think. And so is this becoming a missed opportunity with rising rates over time? So it's in my opinion, worth thinking about this as a potential issue if we free up resources that can be put into longer term investment. There are a number of concerns. Okay, so a fiscal expansion could be in conflict with an inflation targeting central bank. There are consequences of high debt. Okay, we could be vulnerable in a future financial crisis. We have reduced fiscal space. The Economist recently published an estimate, if we take not just public but private debt as well. 12% of world GDP goes on interest costs, burdens on future generations perhaps, though longer term investments may be to the benefit of future generations. So we've got all these types of issues. So if debt remains where it is or stays high, then maybe we need to think carefully about why we've gone into debt in the first place there. So when we think about the way forward, we might say, well, there's perhaps a need to improve infrastructure, but is New Zealand comfortable with that? Are we better with a lower debt to income ratio I think of the work by Reinhardt and Rogoff, published in 2010, which suggested that countries with debt-to-income ratios above 90% of GDP have a 1% lower growth rate. Now, there's a lot of empirical scrutiny there, a lot of critiques of that, but it's out there for consideration. And of course, the prospect that if we go more into debt, then that might lead to an interest rate premium being added to what New Zealand tries to borrow. So I'll move towards rounding things off and say, well, let's think carefully about where we want New Zealand to be in terms of national indebtedness, in terms of where the public debt should be, but perhaps there are opportunities that we want to think about that we can carefully invest in. If I look around New Zealand at the moment, I'm inclined to ask, with one or two things going on, is there a fundamental problem in terms of New Zealand getting projects completed? I see projects out there which are potentially of huge value to the economy. Transmission Gully, that this is a private-public partnership joint venture, of course, 2 years overdue and no guarantee to be finished by the end of the year, but obviously issues why that hasn't really come about. The Auckland Light Rail saga appears to drag on for quite a while. Does lead one to wonder, when will this occur? So, is there a fundamental problem in New Zealand in terms of pushing ahead with projects that are desirable, but not really getting the act together to put them into place? And it seems this has been an issue going on for many years. Okay, I think I've probably used my time up there, so I will hand back to Les.
Thank you for that, Mark. It seems to be that the opportunities that you're looking at here relate to issues of investment, which, again, as you suggest, haven't really delivered, even with lower interest rates. So for now, we'll hold that conversation, and I'll ask for Sir Robert McLeod's view on alternatives and opportunities in this fiscal space. Sir Robert.
Well, thank you, Les, and good morning, everybody. It's a pleasure to be here. As Les mentioned, my background in fiscal policy is tax, and so I'll focus principally on that topic. But perhaps just as a segue to that topic, it's just worth reflecting just on what shapes tax policy and indeed the demand for taxation in the New Zealand economy. One thing I like to remind people of is that the effective tax rate for the nation is probably best thought of as government spending as a percentage of GDP. Most people would not tend to think of it that way, but the point that metric makes is that essentially any deficit in financing spending through taxation ends up obviously in a fiscal deficit, and if it were the other way, we get a surplus. So I like just to remind ourselves that the metric that's important to keep a finger on or an eye on is government spending to GDP. And I think, to me, spending, being a fiscal conservative, spending is the challenge. And the government is resource constrained, as is everybody in New Zealand, let alone the world. And the public sectors and the private sector really compete for resources. So if government spending gets out of control, gets too high, effectively it's crowding out the private sector. And in this debate on fiscal management, one has got to develop a philosophy about what is to be done by our government and what is to be done by the private sector. And conventionally, most thinkers have taken the view that the private sector is more productive in producing our goods and services than the government sector. But I think in modern times that old point tends to be is tending to be put on the back burner. And Carol Lee's comments yesterday morning, for example, about prudent investment which is focusing on government's investments, is sort of taking us in the direction of having more confidence in the quality of government spending and government investing. And for me, that's an empirical matter as well as a theoretical one. It's largely an empirical one. You've got to actually stand back, not only in New Zealand, but in the world, and ask whether the quality in our goods and services and our investing actually comes from public sector or comes from private sector. But anyway, that I think shapes obviously the way a government will think about fiscal policy, because ultimately taxation has got to finance the spending, and the spending is essentially, as I say, a decision as between how much is done by public and private sectors. One thing people may be interested to know is that the New Zealand tax system is lauded by the OECD and is lauded by most overseas commentators. It's held in high regard, and I think it deserves to be held in that regard because of the effort that past governments have put into getting tax policy right. And that's as much about the way policy is done as it is actually about the policy settings. And in 1994, Sir Ivor Richardson gave us the generic tax policy process, which puts a heavy emphasis on shaping tax policies, on consulting with the public sector, effectively seeing tax policy as a joint venture between government and the private sector. In recent times, and from time to time, all through the various government regimes, there's an inclination sometimes for governments to put that process aside and for politicians to rush into legislating tax policies with minimal consultation. As a general observation, looking back on that empirically, those policy changes tend to be criticised the most, or they tend to be the weakest. And I think it's imperative for us to keep lobbying our politicians to ensure that they do, in fact, do the proper consultation in policies that come forward. In the context of the pandemic and in the context perhaps of this seminar, we're sort of thinking about interventions to smooth business cycles. Monetary policy, I think, is rightly seen as the lead steer on doing that, because fiscal instruments are more medium to longer term and they are more clunky and lumpy. And tax policy, for example, is not something that you can necessarily put into the system at short term to do immediate and short run impacts. Probably the closest you come to that ability in tax policy is tax rate setting. But as far as tax base determination is concerned, that is not something that delivers fiscal consequences immediately. And also tax policy on the base design is far more suited to long-run thinking and long-run settings. And you can observe that empirically, let alone theoretically. So take the last reform debate on the Cullen review about our capital gains tax matter. I think that demonstrates that that's a tax reform that not only takes time in terms of its shaping and thinking on the government side, but also on getting it politically past the electorate and getting the public buy-in that those sorts of massive tax reforms involved. In the New Zealand system, we have GST and income tax as our substantial tax-based sources, and it's hard to imagine that those two tax bases leave gaps in covering the GDP. And indeed, in the McLeod review, which I chaired some years ago now in 2001, we proceeded very closely on examining where gaps in the tax base were, and we kind of evaluated the prospect or the attractiveness of taxes by reference to the gaps that they might plug or the gaps that they may fill. And the general view at that time was that there weren't that many. There were some, but there weren't that many material tax gaps. And I, for one, am not a strong advocate for countries putting in myriad taxes and tax types in their tax base. The duopoly of GST and income tax are fantastic mass tax bases that work in partnership to give us the broad coverage that we need. And it's given rise to the mantra of the broad base and the low rate, which is very, again, I think very hard to beat as a practical concept that delivers revenue results and stable results in tax cyclical terms to a government. So I think really the burden of proof is on anybody advocating supplements to those tax bases. Indeed, to the extent that government wants more tax, they've got the rate opportunity in respect of those bases. And there has been ongoing debate about whether the GST at 15 is high enough, or indeed 39% top marginals on the income tax base at the personal level is high enough, 28% for the corporate base. And those arguments go in both directions. But I think that we need to preserve the assets that we've got in our tax policy, and the broad-based low-rate mantra, I think, is part of that. I was just going to sort of touch on the fact also that revenue taxes are there to raise the revenue to finance the government spending. It's important to realise that the taxes as incentives or taxes as instruments to modify behaviour really belong to a different category of taxation thinking. The taxes that we live with in New Zealand, most people think about, are revenue taxes. And the design of those taxes is the exact opposite of the design of corrective taxation or behavioural taxation. Revenue taxes are actually designed not to alter behaviour, because if they do alter behaviour, the deadweight losses associated with them go up. And it's really the province of the corrective or the Pigouvian tax, that narrowly focuses on correction of behaviour or addressing market failure. And I would argue also in the context of a pandemic or fiscal pressures, that dichotomy between revenue and corrective taxes is important to maintain and not conflate. People shouldn't think really about revenue tax design as an instrument to modify behaviour. I'll just conclude my remarks on inflation. I'm really pleased that the commentators to a person all recognise that inflation is one of the most evil things that can be inflicted on an economy. And in the tax system, it is also evil in the sense that it can lead to overtaxation. When you've got negative real interest rates and we're still taxing nominal interest, people are being overtaxed in terms of economic income. And the same goes for other categories of asset. On the flip side, liabilities get a tax break in inflationary times. And obviously fiscal drag, which is taxpayers being pushed into higher tax brackets, is great for government, but actually also bad for the private sector and bad for tax rates in general. And it's important to ensure that governments don't become addicted to inflation, because inflation can give it more tax revenue and can also depreciate its debt obligations. So one way of actually paying off government debt in the future really is to inflate it away. So there are addictive features of inflation that our fiscal masters need to basically ensure that they don't become addicted to. So hopefully those are a few comments and foods for thought that are useful, and I'll pass over back to you, Les, and to Oliver.
Thank you, Sir Robert. Again, some useful reminders of the fact that we have revenue-raising and Pigouvian type taxes, but we move straight on now to Oliver.
Thank you, Les, and good morning, everyone. When in fact it's not a good morning. It is a completely different world from the one we had until last week ago, the world in which we woke up this morning. And I find it difficult actually to talk about fiscal policy on a day when Russian tanks are rolling towards Kiev. And when the global order, the order of post-1989 is really now coming to an end in front of our eyes. Makes it really hard to talk about fiscal policy, but maybe that makes it all the more important to talk about fiscal policy in the world we are facing. If I look a little bit tired, that's probably because I spent most of last night glued to the television, watching everything from CNN to BBC to a lot of German channels, just trying to figure out what is happening. Because I think what we're seeing really is a completely different world emerging with a lot of threats and risks and uncertainty. And that makes it even more difficult, of course, than to talk about alternatives and opportunities for fiscal policy here. But I think we have to. We have to talk about all of this. We have to talk about these global affairs, about these global risks. I don't actually think we do that enough in New Zealand. I mean, the Dominion Post today at least had the conflict on the front page, but you had to go to page 19 to find any more reports on it. And I find that dangerous for us in New Zealand because I think these global affairs, they matter. They will impact us here. They will have an effect on fiscal policy and all sorts of other policies as well. And when we talk about geopolitics, of course, Russia is not the only threat that we see. We could equally talk about China and China's ambitions, not least in the South China Sea. We should probably still talk about North Korea. We should keep an eye on Iran. There is no lack of geopolitical risks today. And it's not just geopolitical risks, of course. We have big economic risks, big fiscal risks, big monetary risks as well. We see the rise of inflation worldwide. And I think for some regions, that's probably a challenge even bigger than a challenge it is to us. I think of Europe, I think of the euro crisis, which never really finished, which has always been kept under wraps, but I think which is coming back now with the rise of inflation in Europe, because the European Central Bank will find it really difficult to balance the needs of some of the EU's member states with the need to fight inflation and bring Europe back to price stability. We could talk about the potential of a global financial crisis. And actually, my colleague Bryce Wilkinson just published a report on that late last year, where we basically came to the conclusion it's probably a matter of when and not if we'll have a global financial crisis 2.0. And then, of course, oil and energy prices, again, linked, of course, to the geopolitical events we're just witnessing now. We have seen the oil price rise above $100 just in the last 24 hours. It's probably not the end of the story. So there are plenty of risks, threats, uncertainty. And I said that makes it really difficult to talk about fiscal policy, alternatives and opportunities. The question I have for New Zealand is, are we prepared? Are we prepared for any of these developments that we can see overseas? And when I say, are we prepared, I mean, not just as an economy dealing with it, but are we prepared with our institutions? Are our institutions prepared? And more specifically, are our economic institutions prepared? The government institutions that actually guide us through fiscal policy, economic policy, and monetary policy. And on that one, I have grave doubts. And I just want to explain that with a little example, which I find telling. It is just a tiny little example, but it tells you the problem in a nutshell. There was a job advertisement from Treasury just a couple of weeks ago. And Treasury, which styles itself as the government's key economic advisory agency, was looking for a senior analyst for its economic strategy team. Now, this is what Treasury wrote into the job ad. It specified that, quote, an economics background is not essential. And instead, Treasury told us about the successful candidate the following. They were looking for someone with good critical thinking skills through constructive debate, good people and relationship skills, comfort working at pace and dealing with ambiguity, probably quite important these days. They were looking for a superb communicator with EQ, the ability to motivate and influence others, an interest in mentoring and supporting other team members. The job advertisement, and really this was all about the candidate, was so bland and so general, really anyone could have applied, probably even my 9-year-old son. If Treasury has given up on even asking for economic expertise, we shouldn't be surprised that we won't get it anymore. And this is a development that has worried me since I arrived in New Zealand. I've been here for 10 years now, and one of my very first meetings actually was a joint workshop organized by Treasury and VIC, where they were trying to develop the first bits of the living standards framework. Frankly, I've been following this now for 10 years. I still do not know what a living standards framework is supposed to achieve that a proper cost-benefit analysis couldn't. And actually, I think it is worse. I think the living standards framework is distracting us from what a proper cost-benefit analysis will actually tell us. It makes it very difficult to balance different competing objectives. It actually prevents the kind of economic rigor that we would expect from a Treasury that we're no longer getting. I think this living standards framework is leading us astray. It is a pentagram. It doesn't really add any value, and it distracts. And when I listened to the Treasury Secretary's speech yesterday, we saw some examples of that. She, of course, went on about the living standards framework, how important it was in the development of well-being policies. Well, actually, what I would like to see is some economic rigor. We're not getting it because Treasury for a long time has actually neglected appointing properly qualified economists. I'm not saying that that's the case for all of Treasury. There are pockets of excellence within Treasury. Look at the housing team within Treasury. They're doing a really good job. But overall, I think the quality of advice coming out of Treasury has diminished. I also found it telling yesterday that in the Treasury Secretary's speech, we didn't hear anything about global risks. It was left to the question and answer session that someone asked about that. And then she gave us a statement, but it actually didn't feature. She talked a lot about fiscal forecasts, but all the big risks, the kind of risks I mentioned earlier, didn't even feature. And I think the worst bit of it was actually then when she talked about climate change policy and the ETS. She asserted without giving us any evidence that we needed policies beyond the ETS, when in fact the ETS actually covers our emissions now. We have a binding cap in emissions trading scheme, and a lot of the policies that you try to introduce on top of it actually are completely superfluous. They don't have an effect on the total amount of emissions. All they do is they distort carbon prices, when actually we need carbon prices to guide our investment in the future. So I think that particular economic institution in our government scene doesn't really help us. It is not providing the kind of advice that would even allow us to identify opportunities and alternatives. And sadly, the same could be said for the other big institutions in the country. I think the RBNZ has come under a lot of flack recently for its management, and I must say I have lost count of the number of deputy and associate governors that the RBNZ now employs. And again, we have a qualifications problem. Recently, the RBNZ appointed a governor or an associate governor with responsibility for macroeconomic policy, but that person didn't have any economics background whatsoever. Or look at the Monetary Policy Committee. Actually, the economics background would be a hindrance now being appointed to the Monetary Policy Committee, because they have actually specified that if you have any previous research in macroeconomic policy, monetary policy, or any research interest for future research, you do not qualify, because they see it as a potential conflict of interest. Well, by that standard, you basically couldn't employ anyone currently serving on the monetary policy committees or boards of governors of the big central banks in the world. I find it ludicrous. And again, the Treasury Secretary was asked in the Q&A session about that yesterday, whether Treasury provided any advice on that, and basically ducked that question. And finally, where we previously got some decent advice on economic policy, apart from Treasury, the Productivity Commission, I read the latest speeches from the chair of the Productivity Commission almost apologizing for the task of his organization, namely to lift our productivity, our actual economic output standards, and make New Zealand a much better, more highly productive economy. I sometimes read the speeches coming out of the Prodcom as an apology for the task for which it was initially instituted. So really, going back to the theme of this conversation, fiscal policy, alternatives, opportunities, I actually see a lot more risks and threats and uncertainty arising from international economic circumstances, monetary circumstances, the state of the banking system globally, but also, of course, and especially on a day like today, from the geopolitics. There are too many risks hanging above us, risks that we in New Zealand, of course, cannot even properly influence. But we should be prepared for them. We should actually take this as our challenge now to make sure that New Zealand can weather the storms, which will come our way. I think it is not a question of whether we will get a new global financial crisis, of whether we will face problems in international energy markets. It is a question of just when this will occur and how bad it will be. I wish New Zealand to be prepared for that, but in order to prepare for this properly, we need all our economic advisory agencies, all our core institutions of government in this field to be prepared for this, to have the intellectual firepower, to have the level of information necessary to really confront these challenges, because otherwise I think we will not be prepared and we will head for very, very dangerous and difficult times in New Zealand. Thank you.
Thank you, Oliver. And I second the issues in relation to the Ukraine and also to global risk. We're sort of running quite quickly out of time here. If I could briefly summarise where I think we're at. Mark Holmes was giving opportunities in terms of longer-term investment with relatively low interest rates. So Robert was, I think, giving us a very clear picture that he believes that the tax base, the tax system is well placed in New Zealand and well respected, and Oliver reiterates some of the issues that Sharon Zollner was talking about in terms of risk. Sharon made it clear that we can't reduce risk totally. Risk will be everywhere, but whether we are actually aware and prepared for global risk. Again, Oliver talked in relation to an issue that has been coming through a number of the questions here in relation to whether our institutions are sufficiently well placed to be able to deal with what are a series of quite unique problems for New Zealand, the issue of a growing deficit and one where we're facing global risks. And I have questioned here, several questions from those tuning in relating to how fast we should be thinking about closing this deficit, and also the relationship between the monetary system and the fiscal system, where in the past fiscal policy has always been playing really the backroom role, and as Sir Robert suggests, this is a medium and longer term role. Monetary policy through the Reserve Bank had a tradition of being very transparent. That transparency seems to be a little more opaque. There seems to be more uncertainty. And the question I'll ask all of you for a quick reply here is the extent to which, moving forward, we need Treasury and the Reserve Bank to make it plain to everyone what their plans are for the future. Many of our people have never lived through inflation. They have never lived through the consequences of inflation. And for me, trying to teach inflation to 18 and 19-year-olds over the last 10 years, basically that's when the laptops open and the cell phones open, because they don't know what I'm talking about. So are we prepared as a nation? Are our institutions sufficiently robust, well-qualified, and powerful enough to deal with this crisis post-COVID? So, Rob, do you want to answer that, put a view here?
Sure, thanks, Les. Look, the question starts with the fiscal deficits and how and the speed with which we should remove them. One thing to go back to, perhaps by way of example, I'm going all the way back to the Muldoon administration, which was possibly the peak of where our fiscal books were in the worst state of disorder, and the switch of government through to the Longy Labor government. And that took a long, long time to work through the system, but asset sales, for example, were a big component of it. Essentially, that fiscal accounting and management really has the capital streams of capital spending and capital receipts by the government, but also has the tax component and what I would call the revenue receipts. And economic national income accounting, that capital revenue distinction is not emphasised, but as a practical matter, it needs to be emphasised. But ultimately, the government needs a plan. In my opinion, it needs a plan on fiscal management in terms of deficit management, which is medium term. It's not sensible to actually make precarious and abrupt changes in tax design, in my opinion, to actually try and get rid of deficits in the short run. And the most important lever for the government in medium-term fiscal management is spending. The spending comes first, and financing of that spending comes second. It's not the other way around. You don't try and spruce up a tax system that can suck out as much revenue as possible from the economy, and then actually have it spend up in the next phase of that. I think Australia provides an interesting example. For example, Australia, total government spending and total taxes, all governments, has been about 5 percentage points below the New Zealand statistic. And I've often wondered why that is. And having spent 7 or so years there in the last decade, I came to realise that actually their tax system has got so much bad design in it, particularly the GST, that it's actually starved off the government from revenue. And that starvation of revenue has caused the spending by that government to actually to be less than it would otherwise be. And I've never actually been an advocate for designing bad tax policy to in fact strangle government spending, although I've been tempted to from time to time to advocate that position. But Australia is a living example of that happening. But anyway, hopefully those remarks are of interest, and I'll pass over to my colleagues.
I've been given a wrap here, so does anyone want to take the last minute away, Oliver or Mark? Mark? I think you're
on mute, Mark.
You're on mute. Mark?
Yeah, I'll just briefly say something on the speed of removal, reducing the deficit, and of course, these geopolitical events can be crucial, and I think economies can be more vulnerable in a crisis with high debt than low debt, and depending on the perceived magnitude and length of the crisis and how it's going to impact New Zealand, then of course that would constitute the case for definitely bringing debt to income down for the economy, and so the economy can be better placed if the crisis hits fully. But I still believe in prudent investment is a way forward as and when the time would be right.
Oliver,
I fully agree with everything that Mark just said, and I would add to that of course New Zealand has a specific challenge to deal with as well. We know that this country every few years gets a natural disaster to deal with, whether it's a volcanic eruption or an earthquake or a tsunami. We have to be ready for these events because they are a feature of our geography and geology. And therefore, I think it is only prudent to reduce debt levels to a level that would allow us in the future to deal with them when they occur again, because, again, they will occur at some stage. We just have to be ready for them.
Well, I'd like to wrap up here by thanking all of you, Mark, Sir Robert and Oliver, for some very insightful observations and comments moving forward. And now I think that we're going to have a short break. This discussion could go on for much longer, but we have to move on. So thank you very much from everyone here at the Economics Forum. And yes, please keep thinking and posting about these ideas. Thank you.
Thank you.
Kia ora, thanks Les. Again, a fascinating session and a theme there about preparedness, as Oliver highlighted, and many of us have been glued to screens watching what's happening in the Ukraine, wondering how that will play out. And I think there's an enormous theme here, and it's come right through the morning, about we don't know what will be around the corner, we don't know what risks are coming, so preparedness in a financial sense but also in a capability sense is fundamental. We are going to go to a break now. It'll be about a 10-minute break. We'll be back at 11:15 with a perennial Kiwi favourite, housing. Obviously some of the other policies that we've touched on this morning have big impacts on that. It's a huge part of the economic life in New Zealand. And then the last session of the day will kick off at 12 on the global picture, another fantastic panel, and it's never been a more important time to discuss that, and we'll wrap up just before 1 o'clock. So we'll see you back here at 11:15.
Wharehui Mulroy gifted the name Raupapa, Te Raupapa, to the management school, and for me, Te Raupapa just fits this space. Raupapa as a single word means to arrange things and put things in their place so that they make sense. But that doesn't mean that they stay there. They can be rearranged and they can be reworked. So as a simple word, that management in that word it fits.
It's amazing to look at the management school and its achievements over the last 50 years, to imagine this place as a couple of small prefab buildings on the side of a hill in Hillcrest, to all of the achievements since. Right from its founding, the Waikato Management School Te Raupapa has been focused on innovative management and business education. That started with the innovative 4-year Bachelor of Management Studies, the BMS degree, right through to being the first management business school to launch a digital business qualification, the first in New Zealand and one of the leaders in the world in incorporating sustainability right at the centre of our strategy, through to the first in New Zealand to achieve the Triple Crown accreditation, which places us in the top 1% of business schools globally. And then even more recently in the last 6 months, named as number 1 in New Zealand for business and economics and in the top 125 in the world in Times Higher Education rankings. So when you look at that and then look at the impact our research has had and look at the impact our alumni have had, more than 24,000 students, from Prime Ministers to CEOs to iwi leaders to community leaders to just fantastic people going out and making a difference in the community. It's something to be so proud of. Kia ora and welcome back to the New Zealand Economics Forum here at the University of Waikato. I've just taken a short break. Even in that time I connected with a couple of friends and colleagues offshore, and obviously all watching the unfolding events in the Ukraine and closely, so it's a very sad situation that's happening there. We're moving into the home stretch of our two-day forum here. We have two sessions left. The first is on housing and infrastructure, and then the last will be that session on globalisation. So for the housing and infrastructure session, again, a very strong panel, and I'm going to hand it across to my colleague, Professor Frank Scrimmager of the University of Waikato. Frank, over to you.
Thank you, Matt. It's a great pleasure to have our panel here today. Dominic Stevens, Leilani Frew and Brad Olsen, all well-known people with long experience in housing and infrastructure. So we'll go straight into the presentations. Before we do that, I just make the one observation that last week housing in New Zealand made The Economist, so we must be doing something right or something terribly wrong to get there. So let's see what the insights are. We'll start off with Dominic, then go to Leilani. Welcome, Dominic.
And thanks very much, Frank, for the introduction. I do think it's fair to say that over the past 20, 30 years, the rise and rise and rise of New Zealand house prices has really bested many economic forecasters and policymakers in New Zealand. And I think as a profession, we owe it to the public of New Zealand to confront that fact and to think through, well, what is it about the housing market that is behaving a little bit differently to perhaps what we've thought? I thought Jim Bolger said it really well in his sort of closing remarks yesterday. He talked about the definition of insanity. It's trying to do the same thing over and over again and expecting the same different result. So I think the dominant idea that has pervaded thinking on the housing market in New Zealand for the past 20 years is that the ups and downs of house prices, or mostly the ups, are related to physical supply and demand of dwellings on the ground. So whether house prices go up or down, people talk about migration, construction activity, the relationship between the two, or perhaps construction costs. And I really think that idea, it really has theoretical merit, but it's really been challenged by the data on the ground. Most obviously, over the past 2 years, we've seen zero net migration to New Zealand, so very, very low population growth and absolutely booming construction activity, highest in decades. And yet the rate of house price inflation has been the highest on record off a really big base. More subtly, if we look back over 20 years, well, if it was really about supply of dwellings and the housing shortage, or there is a housing shortage, if that was the cause of rising house prices, well, it should have caused rents to rise too. But actually, over 20 years back to 2001, rents are up in real inflation-adjusted terms, 47%. House prices have more than trebled. So the difference between the two is a completely different order of magnitude increase between prices and rents. And indeed, it's the house price to rent ratio and the blowout in that ratio that needs explaining. Construction sector, again, probably has played a role, but in real inflation-adjusted terms, again, since 2001, purchase of new dwellings, part of the Consumer Price Index, which measures the cost of putting a dwelling on empty land, up 67%, house prices up 240% in real terms. So again, most of the increase is actually in land, not construction. And then finally, there's just no concordance between where the population growth and housing shortages have been in New Zealand and the house price inflation. Actually, there are 4 territorial authorities that have had population decline over 20 years, and they're among the biggest house price increases in the country. So I think there's definitely some real challenges to the way housing markets have been thought about, and I'm pleased to say that at the Treasury and elsewhere, that how we think about housing markets is changing. We heard the Reserve Bank Governor just today say that, or acknowledge that the biggest cause of rising house prices over the past 20 years in New Zealand, according to their research, is a global decline in interest rates. At the Treasury, we are putting more focus on interest rates and our house price forecasting. Of course, interest rates affect asset prices of all stripes. They drive them up relative to the underlying stream of earnings, and New Zealand houses are no exception. But the really interesting thing is why drops in interest rates lead to higher house prices, not lower rents. And that comes down to the supply of land opposed to the supply of dwellings. As I say, the traditional thinking on the housing market, it's got really good theoretical foundations. It's based in the traditional housing model, which actually at its core has an assumption that there's plentiful land available for development. So if there's something like an interest rate decline comes along and it's permanent, well, that could drive house prices up, but it'll drive them above the cost of getting some more land off a farmer at the edge of town, and plus the cost of actually putting a house on that land. That'll create a supply response, and that'll bring house prices back down again. And actually that model predicts that a permanent decline in interest rates would lead to lower rents over the long run. And actually that traditional model is unable to explain persistent changes in house prices relative to incomes. It can't. And that's why forecasts typically think that housing market will come to its senses and come back down when they see house prices go up, or that people think about, well, there must be something wrong with the construction response because supply hasn't kicked in. I think the theory of that model is fine, but the underlying assumption of plentiful land just is not New Zealand's reality and has not been New Zealand's reality for quite some time. I think, in fact, in New Zealand, the ability of urban areas to obtain land for development, either out or up, so to use land in a different way, either out or up, is really very constrained. So restrictions on the supply of land really change the way you think about housing markets. And I'll just get you to imagine for a second a world where land was completely restricted. Well, in that case, price of land will have nothing to do with the value of a farm at the edge of town. Rents will be anchored to what tenants can pay, so incomes and physical supply demand of dwellings, that sort of thing. But if an interest rate decline comes along, well, that'll drive house prices up as the net present value of the future flow of rents goes up. So, standard asset pricing theory. But here's the key: what will happen is that decline in interest rates, or the value of it, will get captured in the value of land if land is really very restricted in supply. So what you'll see is land prices going up as well as house prices, and the gap between the two won't change, meaning no real change in incentive to build new dwellings, no supply response necessarily, and not necessarily any change in rents. And in fact, that's a general idea that if land is really restricted in supply, then changes to things like taxes, even construction costs, will be captured in the value of land and will not necessarily alter the incentive to build new dwellings on that land, and will therefore not necessarily alter rents. And I think that's why we're seeing house prices respond to interest rates, not rents. Now, I do want to qualify a couple of things here. I've just sort of presented a really extreme case of completely fixed land supply and contrasted it with completely abundant. Neither is the real world. Actually, reality lies somewhere in between, and what we need is more thinking and research on where New Zealand sits on that spectrum. And also just want to qualify that I'm not for a second saying that physical supply and demand doesn't matter at all for the housing market. Of course it does. It really matters for rents, for example. It's just that we can tell its importance by what has happened to rents. We can see, say, for example, Christchurch, after the earthquakes, you saw supply of housing relative to the population really dropped away. You saw rents rise actually more than prices. Supply response kicked in, rents and prices both underperformed the rest of New Zealand. That's what a market looks like, experiencing a shortage of dwellings, and it just doesn't explain a lot of what's happened in the wider New Zealand housing market over 20 years, although it does explain particular places and particular times. Okay, so restricted land supply, or falling interest rates in the context of restricted land supply, is the biggest thing going on in the New Zealand housing market. How does that affect our policy thinking? I think, first of all, we're using the relative role of interest rates relative to migration and physical supply demand is changing in our forecasts. We're putting more weight on interest rates. Secondly, your policy solutions are going to really zero in on the effective supply of land, the ability of urban markets to access or change the use of, either change the use of land within the urban area or access land on the outside. And that's what I'm hoping Leilani will talk about, and it's why we've got infrastructure connected to housing in this topic. Outside of that, I think that the idea that changes get absorbed into land prices means we should revisit tax. When we think about the housing market, I think successive tax working groups have feared that taxing housing would reduce the incentive to build new houses, causing a reduction in supply and an ultimate increase in rents. And again, I think that's abundant land supply thinking, and New Zealand's reality is actually different to that. I think we should really focus our attention on what drives rents, both because if you're locked out of the housing market, rents are really what matter to you. They matter for well-being, but they're also really important for thinking about, well, if we're thinking of housing kind of prices are being affected by their investment value, well, the underlying stream of rents really matters. And lastly, I think we need to zero in on what the problem actually is in New Zealand. It's actually, interest rates have fallen so far that it's actually really very affordable to service a mortgage, even at very high house prices now, relative to incomes. What's changed is the affordability of a deposit. It's exceedingly difficult on New Zealand incomes to muster a deposit to buy a house. That is the actual nub of the issue, and it's causing people to be locked out of the market. So let's zero in on that and maybe consider what would help people overcome that essentially liquidity constraint of mustering a deposit. Thank you.
Thank you, Dominic. You've put a number of issues on the table, and so we'll go to Leilani.
So thank you for the opportunity to join you today, and to the University of Waikato and Waikato Management School for bringing us all together. So the topic of housing and infrastructure is so broad. I think we could go in a number of directions, and I appreciate that Dom has sort of zeroed into a couple. But I also appreciate that the Q&A section of this panel may indeed go into more broader areas. I did want to kind of start with the qualifier. I'm not an economist, so I'm not going to come at the discussion from that perspective. So apologies to those that may hope that I do. I am, however, fortunate enough to be a homeowner. I'm fortunate enough to be a home investor, and I am currently a renter as well. And in my day job, my focus is on the delivery end, enabling housing and infrastructure to be delivered and bring that perspective to the policy development and implementation activities of government. So kind of what is my perspective? I start quite at a high level. We've all got these really basic needs and expectations when it comes to housing and infrastructure. Home is a base where we and our whānau can feel safe and warm. And infrastructure that kind of connects us to all the places that we want to either work, live, play, and or access the services that we're looking for to be personal services that we need. And so Dom mentioned, we've got some growing population challenges, and I would add into it changing citizen expectations on how we want to actually access those places that we want to live, work and play and get services from. So those couple of factors have kind of created this step change in how we need to think about housing and infrastructure. So I fully support Dom's perspective that we need to really quite think differently as we sort of lean into those headwinds that are creating the challenges for us. But in particular, from my perspective, it's about how we facilitate and enable that access to housing and infrastructure that's important. And unfortunately, there's no silver bullet, no one-size-fits-all kind of solution, as you all know. Many drivers that are impacting access and enabling. They're varied, they're diverse, they're interdependent. And Dom's touched on a few of those. What also is clear from my perspective is that there is a need for the whole ecosystem to align to deliver all of these solutions that are grounded, really kind of grounded, enabling people to get access to housing and infrastructure. So there's a real role for the private sector, as employers, for jobs, banks, access to financing, businesses in terms of access to construction and supply, the supply side. And there's definitely, obviously, a role for government in the regulatory policy and funding side. So again, supporting predominantly access from the supply side. So as Dom mentioned, it's pretty clear from government perspective that restricted land supply is one of the biggest underlying drivers of the high cost of housing. And I'd also suggest that it's also quite a constraining factor in our ability to provide infrastructure needed to service the populations and the regional and city centres when they need it. So, and what can government kind of do is, as I said, I'm kind of focused on the delivery end, and agree completely with Dominic's position that the focus has been on creating a greater ability to free up land supply for housing and infrastructure, and also a greater ability to enable development now and into the future. So things like planning for more growth, up and out is probably the way to think about that. Greater land use and infrastructure integration, and we've seen a few recent government announcements that are very much around integrated housing and infrastructure projects coming forward. Wider use of infrastructure corridor and site protections to facilitate and maybe reduce the impact of land price inflation when and if government's ready to make those sorts of investments. Creating a sort of a more enabling regulatory environment that provides the ability to not just look at how we implement change or getting planning approvals through easier, but also the types of change that are going to be needed in those types of planning approvals need to kind of be facilitated a bit easier. And then infrastructure funding and financing, I think it relatively speaks for itself. And then the other sort of sleeper is probably the capacity and capability of the whole ecosystem to deliver. And I'll touch on that one a little bit later, a little bit. So the focus, therefore, what we are doing is in terms of enabling access and facilitating some of those outcomes I just mentioned. A lot of focus in that planning space. The key signature, I guess, activities around the repeal of the Resource Management Act. I know you're very, very, very familiar probably with what that act is trying to achieve, taking one act, breaking it into three, but very interrelated pieces of legislation. One that focuses predominantly on the natural and built environments. It's going to be the primary piece of legislation that replaces the RMA, and it's focused predominantly on land use and environmental protection. It'll work in tandem with the second act, the Strategic Planning Act. That's to set out an approach to long-term and strategic planning around how we use land and the coastal marine area in New Zealand. And then the final act is around climate adaptation as we lean into the complexities of what we need to do to really address the complex environment that we need to operate in to meet the needs and commitments for the country in terms of climate change. So taken all together, those three acts are kind of going to being brought to the fore now, and really trying to support that enabling role in the regulatory space, particularly the planning space, and facilitating easier decision-making to unlock sort of land supply, as an example. Big piece and definitely a big lever, and I think an important lever, but it's not sufficient alone to address the issues. So infrastructure provision and funding is also going to play a really key role in enabling the development that the Act sets up us to be to take a step change in the way we address these issues. But we do need to realise that it's not the silver bullet. It's not a silver bullet. So one initiative that's happening at the moment is there's an IFF Act 2020, and it was established to enable new funding and financing for the provision of new infrastructure for housing and urban development. So not the big I infrastructure, not the big trains and schools and hospitals, but predominantly the small I infrastructure. And in my opinion, the most important infrastructure to facilitate increased land access for housing. Infrastructure like telecommunications, water, sewerage, and local roads. So that's, a sort of initiative that government's pushing forward with to try and acknowledges and realises that enabling infrastructure for land development is just as important as having the land itself. I note that even if we do get some of those enabling factors that I just mentioned sorted and in place, as I mentioned earlier, it's the capacity and capability of people, businesses and government that will be just as important to make sure that we address the challenges in front of us. That ecosystem that I mentioned earlier, getting that aligned and working together. I appreciate that is a whole topic in and of itself, but as you all know, we're already seeing headwinds, particularly say in the construction space, of the constraints that are impacting our construction sector in particular around capacity and capability. And unless we kind of find a way to address those, I think that they will also impact the speed at which newly available land can be developed and released to support housing and infrastructure development. So I'll probably leave it there, and hopefully I've given a couple of perspectives of how I see the challenges and shared, what government's kind of doing to try and enable greater access to land and infrastructure, and look forward to the Q&A part of the panel discussion.
Thank you, Leilani. We will go to Brad, but before we get to Brad, I just encourage him to be brief. It's really good if we can get some Q&A at the end. So, Brad, we look forward to your sharp and incisive insights.
Kia ora, Frank, and kia ora, and good morning, everyone. I will keep them brief. I think Dominic made an important starting point, very clear, around that need to acknowledge where we've gone wrong previously. And I think to expand that, certainly New Zealand as a country, I think, needs to admit the failure that we've had when it comes to infrastructure, because really that is at the key of where we've gone wrong and just how we've got ourselves into the position that you're telling young New Zealanders that they need to find, potentially $250,000 in a deposit to get into a house, because the wellbeing implications are clear. New Zealand for a long time has really suffered with that underinvestment in our infrastructure and our ability to both provide, fix and maintain the network assets that really keep us going. And I think we need to consider as well what we do differently in that space. Our analysis of infrastructure across the country and internationally has shown that New Zealand has underinvested relative to our international peers over a number of years. We've invested at a rate below the likes of the US, certainly below Canada and Australia, and a touch below the UK as well. And it shows. In Wellington, we have poo every now and then running down the streets. We have hospitals, which are in disrepair, schools as well. And I guess we must ask ourselves how we let ourselves get to that position. How did we not figure out that things were breaking around us until we put a media spotlight on it? And it suggests, and importantly, going forward, we must have a much better focus on asset management. Because as we've seen, and as Dominic's pointed out, the supply of land and the supply of housing becomes secondary to that supply of land, and actually being able to do something with that land, change its use around, is critical. Yet at the moment, we are spending most of our money when it comes to network infrastructure on asset maintenance and repairs. We're not actually putting a huge amount into additions. And it does really highlight Leilani's point around the need to better fund our infrastructure. I do want to make a point around supply and demand, and note that although we all see nearly 50,000 consents a year in the headlines and talk about how much building we're doing, we, in our mind at Infometrics, do highlight that we're probably only just right now, this year, starting to build more than we are needing to. That huge increase in supply is important, but relative to where we've previously been, we've underbuilt for over a decade. We're only now starting to get into a better position. And as politicians of both sides have often made the point, you cannot live in a dwelling consent, you can only live in a dwelling. And in our estimates, we're still a few years away from actually getting things in a better position. By that time, we will likely have more pressures coming onto the housing market. So the point around there being no silver bullet from Leilani was very well made, and my submission there would be that we should throw the kitchen sink at it. Just finally, I want to discuss why housing actually matters. Dominic touched on this from a wellbeing point of view, but I think it is important to go to a very basic level for New Zealanders, that if you don't have a home that is comfortable, if you don't have something that you can go to sleep in at night, you aren't going to be a very productive member of society. You're not going to worry about going to work and being your productive best. You've had a rubbish night's sleep. You're not comfortable. You're cold and miserable. So really, homes and housing does set the foundation for New Zealanders, and we know that those at the bottom end have been left behind. Since 2016, lower quartile rents have increased by 34%, but medians have only increased 29%. So we know that squeeze at the lower end has come through quite clearly now, with 25,000 New Zealand households on the waiting list. And as we move forward, that difficulty that we find, particularly for young New Zealanders, becomes a huge intergenerational challenge, where we've made decisions as a country that young people will be screwed over on the housing market as we go forward. That is the decision that New Zealand has made. And it does suggest we need to rethink all policies that we have on the books. And I'll leave, and the point that Dominic has very well isolated, and the point that I made at the start is around the difficulty when it comes to housing relates mostly now to the deposit requirement. And I remember quite fondly my grandfather, late grandfather, noting the potential of government support back when he was young, State Advances Corporation, the capitalisation of the child benefit and similar. At the moment, I will save my own KiwiSaver. I get $1,000 a year, $1,000 at start and $500 a year from the government. Chump change, really, compared to what other support has been seen previously in New Zealand. We do need to rethink that entire model, the entire ladder, and the entire amount of state support that we provide, because for too long it's been focused on subsidising the continued rollover of housing through the accommodation supplement and similar. We haven't built enough state homes. We haven't used the Crown's balance sheet to actually invest properly in infrastructure and maintain the basic bones of New Zealand. We are paying the price for it. Unless we make those changes now, we will continue to suffer, and young New Zealanders will be locked out of that future increasingly. Thank you.
Thank you very much. So one of the key themes which comes across all presentations is the supply of housing, and coming back to the supply of land. And my question is, the recent legislative changes, the changes to try and increase capacity to dwell in the major urban areas, to what extent is that going to alleviate things, or is it not? We know that many councils haven't complied with national policy statements on urban developments. What can be done to increase this land supply? What are the next steps? So, Dominic, do you want to go first, followed by Leilani?
Yeah, and I think that'll be a good combination. I'll talk to the sort of where are we on the spectrum, and I'll let Leilani talk about what could actually drive a difference. Actually, the answer, Frank, is we don't know. There's a number of years ago, there were some metrics generated on sort of relative availability of land, but they've sort of fallen into disuse. So I'm chairing a housing technical working group, which is a collaboration between Ministry of Housing and Urban Development, Reserve Bank of New Zealand, and the Treasury. And one of our key research topics is to try to understand. I mentioned that in reality we're somewhere between this world of fixed land supply and a world of abundant land supply, and we're somewhere in the middle, and different parts of New Zealand will be in different places. And I'd really like to get a metric of where we are on that spectrum and where different parts of New Zealand are. And then secondly, I'd like to do further research on how far that spectrum can shift. My sense is that actually it can shift, but it's slow, really slow. And more institutional than simply, let's build this piece of infrastructure here. It's deep down in the institutions of the nation. But that's my sense. Let me hand over to Leilani to give more of a sense on how to try to shift that dial.
It is a big question in and of itself, and it's multifaceted, I suppose, in terms of answers. I think one of the things that the RMA Act's trying to do is actually, what is the plan? What does the plan for our cities and our regions need to look like to support future generations and the population growth? And that sounds easy to do, but it's actually not, because it does also need, therefore, a number of partners to come together to sort that out. If I kind of reflect on my experience in New South Wales, because for me, coming to New Zealand 9 months ago, there were some elements that I was recognising in the challenges and issues that we are having here that resonated with me from when I joined the New South Wales government about 10 years ago. So similarly, infrastructure deficit after 16 years of non-investment, the issues that Brad raised in his talk, housing affordability going up, system not really some levers in the system not quite set up and strong enough to support the ambitious agenda that government had, which was to address housing affordability and infrastructure. One of the things that they did was they started to look at how do they support regional and urban planning. What is needed? Where is it needed? Where do people want to live, work and play? And so those factors came into saying, well then, and then what do we actually do to address that? And so at the moment, we don't quite have that baseline. So we have a number of tools, like we're getting money to get it together. We're getting planning acts and everything being amended and addressed to work out, to make it easier once we get to figure out what we have to do to make that happen. But we still don't quite understand or have a clearer picture at quite transparent levels where people want to live, work and play, and what therefore do we need to facilitate in terms of infrastructure, and then what does that mean in terms of housing, and what does that mean in terms of do we intensify or do we go out and spread? So there's a lot in there, and I'm not giving you any direct or short answers on it. But I think that what we have is that some pillars that need to be delivered. And I agree with Brad, it's going to take some time to get those things in place before we can actually see what's possible.
Thank you.
I guess just adding to that, and I will be a bit more definitive and very brief, I think the changes we've made recently are very much a step in the right direction, and importantly starts to change our frame of reference because our prior settings, our prior laws had a very hands-off approach. It was you can develop, but there are constraints, and sort of how you develop we don't care about, but there are settings and frameworks in place. Recently though, we've said actually no, we're more permissive, we're a bit more forthright. The country as a whole, through our political leaders, is saying yes, build, don't not build, go on and do it. And in fact, for those of you who didn't want to build, sorry, your choice has gone, because your property rights at current are impinging on people's future property rights, and there is more fairness over generations that need to be introduced. So I think that's important, because I do think it starts to shift the psyche. We're now in a position where we're saying yes to things more than we're trying to find reasons not to go ahead. But that does need to continue, and I speak particularly in the local government sector, where indeed in my mind the incentives still aren't strong enough to do it, because for a new development you go along to a council and it's not often that you necessarily find someone with a bottle of champagne saying you want to build, let's go, let's have fun. And importantly, that's because, again, for a council, additional work, yes, means eventually additional income, but importantly, additional expenses to start with. And that focus, like I said, from an infrastructure point of view, has been very, very skewed towards maintaining what we've got, because we let it get so run down for such a long time that we cannot easily fund expansion. And so it does suggest that alongside the changes we've made to infrastructure funding recently, we need to go further. And again, I start to ask if we need to be much more forthright. Instead of financing, for some large developments, the taxes that people have paid in recent times and people will pay in the future could well allow us to get ahead of the ball if we are courageous enough to do it.
Brad, I'd like to go back to you again to continue this. My concern is local government funding of infrastructure. It doesn't seem to be happening at a speed that we would expect. And so my question to you is what can be done to speed that up and get some momentum in this space?
Oh, I think a lot. I think at the moment we also probably need to recognise the temporal issues that we face around the country. There is a lot of stuff going on and we simply can't do it all. We're pushing up prices. What I do suggest though is we need to have a much better focus on prioritisation. Economics is about scarcity. We know there's only so much resource in a certain given period of time to do stuff. What is it that New Zealand decides is the important thing to pay for right now? Is it sports stadiums, convention centres and similar? Is it hospitals or schools? Is it roading? Is it apartment blocks? Is it office blocks? We don't know. We make no decisions, and importantly, we have not, in my mind, put the right sort of pricing incentives in there, because the pricing metrics matter. But going forward, I think as well as that, you sort of see the difficulties that we face. You look at the challenges that local government has also from a purely political point of view. Now, economists don't often touch on the political view, but realistically we must remember it. And so I think the direction setting that central government has provided is important, but there is an increasing need in my mind that if the government takes the money from local government in the form of GST, in the form of building consent fees and similar over time, there is a need to remit some of that back to find a better funding stream than we currently have. At the moment, the government provides a subsidy for roads, but if a local council wants to fund some water pipes themselves or any other sort of infrastructure, sorry, that's on you. We are not, in my mind, having a full discussion about the financing that could be done. I think the infrastructure financing that came through in 2020 is an important step in the right direction. More of that, please.
Thank you. So we've got 6 minutes left, and I'm going to allocate you 2 minutes each, and I've got 2 questions for you to answer in your 2 minutes. So what's the most important thing to be done in the infrastructure space going forward? Question number 1. And question number 2, what else is your priority? What's your first priority in leading to an improved housing market and improved housing outcomes for New Zealand citizens? So we'll start with you, Dominic, Leilani, and then Brad.
If you don't mind, I'll start with the second question, just in case I run out of my 2 minutes, but it's the tax system. So the tax system in New Zealand favours ownership of assets that yield capital gain rather than taxable income. Housing really firmly fits into that category. I'm concerned about the equity considerations there, because those locked out of the housing market don't access those tax benefits, while those who do have capital access the tax benefits. Secondly, I think that's, again, in a restricted land supply world, what we expect is that tax benefits for housing manifest in higher land prices. So I think changing it there would affect land prices more than rents or supply. Infrastructure, only point I'll make is I think Brad's right that this needs to be a centralised effort. So basically, if you fix up availability of land in one part of New Zealand, what will happen is people will flood to that part and quickly exhaust that availability of land. So it really does need to be a nationwide effort so that we don't get this cross-city sort of equilibrium occurring. Thank you.
Yes, and I guess my theme, I'm going to take some liberties on the infrastructure one because I think there's 2 for me. There is that coordinated planning aspect, which is related to what John's just talked about. But I think we can have all the plans and we can have all the enabling legislation and acts and everything. But if we don't have the capacity to actually make it happen, then it's all for naught. So I think there needs to be this now, while we're getting all of the other things sorted, some real focus on how we're going to attract the skills, the capability and capacity and experience to actually deliver and to position ourselves to be ahead rather than catch up, which is the point that Brad raised. So in terms of housing, and what's my priority at the moment, it's just getting those the work on the Reform Management Act through at a very micro level.
to look at the infrastructure, I think we need to have asset management planning going forward and looking back, and the ability probably for the Infrastructure Commission, rather than taking everyone's capital plans and sort of noting them, to be much more directional and say, no, we don't need these resources right this second in this area. We need to redeploy our resources into pipes or whatever it might be in Taranaki, because that's where we see the greatest need, and also therefore the funding that's attached to that from government. I think in terms of priorities, I'd agree with Dominic in terms of the tax system. I feel like at the moment we are screwing over younger New Zealanders and we are increasing the wealth gaps. As we move forward, New Zealanders will only be able to get into property if they inherit it going into the future, and for those families that don't already have property, they will continue to be locked out. We either face that problem front on and soon, or we wreak the havoc that we continue to see and exacerbate the challenges for future generations of Kiwis. It's quite simple.
Thank you very much. So we've made a lot of progress. There are still issues in play. I put on the table this whole discussion about the replacement to the Resource Management Act. Is it coming fast enough? Is it dealing adequately with the challenges? I think that's another further challenge for us. There's lots of questions come through on the Slido. We haven't been able to get to them all, but it does seem that the supply chain issues are exacerbating the problems that we're facing in the short run. And one of the questions is how soon we will get through to the other side of that. The other issue that's coming up is the current lending requirements associated with the banking system, their interpretation of the recent finance legislation. And I wonder whether, Dominic, I'll give you the chance for a final observation on that matter.
Yeah, I think I agreed with the way the Reserve Bank looked at this. I think those lending requirements are going to have a fairly transitory effect on housing markets, if they are at all. I think the real reason that house prices have started falling, and they've fallen over December and January, is that there was a really sharp lift in interest rates around September. And that's about the normal timing in New Zealand. We've seen it before. Big change in interest rates, you see a shift in the housing market, and it's coming to pass. Yeah, thanks.
Thank you very much. Thank you to the three of you for your contributions today. Very helpful, and we look forward to this conversation continuing over the coming months, and hopefully better outcomes in infrastructure and housing markets. I'll hand it back to Matt. Thank you very much.
Thank you, Frank, and thanks to the team, Te Leilani, Dominic and Brad. And as you're highlighted, and Brad, you said quite eloquently, it's not housing for housing's sake, it's the impact that has on the way that people live their lives. Look, we've come to the last session of the 2022 New Zealand Economics Forum, and of course there's no bigger topic than the global and the geopolitical situation today. So I'm going to hand across now to Stephen Joyce, who will moderate a panel. We have a fantastic panel of speakers here for this topic, and I'll hand over to Stephen for the last panel session. Thanks.
Thanks, Matt. Kia ora, everyone. And well, what a session that we're walking into with everything that's happening around the world in the last 24 hours, and in particular in Europe, with Russia invading the Ukraine, and pretty much as we speak, tanks heading across the Ukraine countryside, which probably does change slightly the tenor of our discussion today. Obviously, we want to be cognizant of what's happening there. We do also want to get to the more macro issues, and I'm sure our panel will do that for us, and the impact of what we're seeing on decades-long trends like globalisation and so on. Anyway, we have three excellent panellists for this discussion. Firstly, from the University of New South Wales, Professor Gigi Foster, Professor of Economics, who's joining us live from Sydney. Thank you very much, Gigi, for doing that. We have Rodney Jones, Principal Economist and Analyst at Wigram Capital Advisors. And we have the Honourable Tim Gross, a former Minister of Trade, and climate change issues, but also a long-standing diplomat with quite a lot of experience around the world, including in Europe. Now, we're changing the batting lineup slightly today on what we'd planned. We'll get Gigi to continue to go first. Tim's going to come in second and probably do a bit more specific stuff around Russia and the Ukraine and the impact of that. Although, Gigi, you're most welcome to start with that. And then Rodney is going to look a bit more specifically at the China situation and perhaps some lessons through there. Now, I've talked to all the panellists ahead of time. We're going to do sort of 5 to 7 minutes each. And again, the aim of the exercise is to have a good discussion for about half of our time. So there's a chance to sort of lay out the key arguments, and then we'll come back to them. So Gigi, thank you very much for your time, and over to you.
My pleasure. Thanks for having me, and thanks for forging ahead with this conference despite the online and in-person debate that was going on for a while. So I want to use my 5 to 7 minutes to focus on the things that I think are most important for the Antipodes going forward. I will speak a little bit about Russia and Ukraine, but the main thing that I think is important to bear in mind is that the last 2 years have been a catastrophic policy ball drop. They have been very, very bad for the economies and the welfare of both Australia and New Zealand. And so the best thing that we can do going forward for our economies is to exit the COVID madness as quickly and sort of methodically as possible, while reassuring people that this is the right direction to go in, because we have basically paralyzed people with fear and really hurt them in terms of their perspective on COVID and other health problems. And we need to help them to recover some sense and to be able to then activate their consumption and investment behaviors as they need to be activated in order to grow our economies going forward. So the first thing is to drop all of these restrictions about COVID that are limiting business and consumption activity all over the Antipodes, while again reassuring people. And I think that some use of things like on-the-spot testing or other kinds of very easier, I suppose, methods to reassure people are much better than border restrictions and mask mandates or other kinds of mandates that are really distracting from what New Zealand and Australia need to work on going forward. So that's the first thing. The second thing is that as part of our COVID policy response, we have seriously disrupted many of the industries that Australia and New Zealand have relied upon in the past, and that really play to our comparative advantages. Immigration, tourism, education, the arts and entertainment, of course, but all of these things, maybe with the exception of arts and entertainment, rely heavily on borders being open and people being able to freely move about, and capital, of course, as well. And so from my perspective, and I think that the politicians here in Australia do see this, I'm not sure whether that's the case in New Zealand, but I think we have to refocus on making our countries an appealing place to work, study, do business, and live. And so we need to try to get rid of the brand image that we have at the moment of, very scared populace with a lot of control response to anything that's potentially going to be threatening, not very much risk tolerance, and not a very friendly place to be if you happen to get caught here when there is a crisis, because you will not be treated very well. You'll be turfed out, as our temporary migrants and our students were at the height of COVID. So I think we need to repair our brand damage, basically, repair the image of the brand of Australia and New Zealand, and try to encourage as much immigration as possible and tourism and students coming back and all of that. If we don't do that, see, the issue is not that the economy is necessarily going to sink in the short run. In fact, we see here in Australia that the unemployment rate is very low. The GDP doesn't seem to be, taking as much of a knock as people had expected, although that's always an in arrears number that we collect and release here. But it just doesn't seem that there's the evidence yet in these kind of standard statistics that we've really hurt ourselves. But in the long run, without immigration, we will grow more slowly, we will become more parochial, and there's a danger of being more xenophobic. And I think other countries in the world, like, for example, Scandinavia, the UK, who are dropping those restrictions, will not suffer those longer run effects. And so over the longer run, Australia and New Zealand risk being left behind. So that, to my mind, is the main danger. Very briefly, the other things that I'm looking at, the labor market is a very interesting phenomenon at the moment. People are reevaluating where they want to be in the labor market. They're changing their hours up. There's obviously been so much disruption that New choices are possible. Sometimes new discoveries of technology have been made, which I think will stick. That's fine, but I don't think we're going to get back to the levels of productivity that we were looking at pre-COVID for another probably couple of years. Natural resources, of course, is a huge issue for the Antipodes, for Australia, particularly in iron ore, for example. For New Zealand, I suppose you have your sheep and a lot of other things. And so I keep an eye on the iron ore price. And of course, that comes down to how much construction is happening overseas, including in China. The debt repayment that, of course, is going to have to happen, which will crowd out other kinds of expenditure. I worry that may also, drag the economy down and human welfare down with it. Now, on Russia and Ukraine, from my perspective, is a bit of a useful distraction at the moment for us to be thinking about something other than COVID. I wish it weren't a war. But I think that maybe it will help some people to recover some sense about what's actually important and speed our exit from the COVID madness. I think I'll leave it there.
Okay. Thank you very much, Gigi. I'm sort of sensing that you think some of the health response has overwhelmed the economic response for COVID. We'll come back to that definitely. Let's go and talk a little bit more specifically then about Russia and Ukraine and the impacts globally. We have seen dramatic scenes in the last 24 hours, and I'm sure we'll see more in the next 24 hours. Tim Grosser is former diplomat and foreign trade minister who is very familiar with that part of the world. Tim, I know I asked you late this morning whether you could change your comments a bit to give us a bit more of that flavour. I hope I didn't catch you too much by surprise.
No, not at all, Stephen, and thank you for inviting me on this panel. I'm going to start with an anecdote which I think has suddenly become very topical because I happened to be in Moscow at the time the Russians started this process of trying to redraw the map of the Ukraine. So I had a long-standing relationship with essentially Russia's chief trade negotiator when I was still WTO ambassador and chairman of the global agriculture negotiations in Geneva. And I wrote a think piece for his boss, Elvira Nabiullina, who was then the Minister of Commerce, and now she's the governor of the Central Bank of Russia. Boy, she's going to have her hands full in the next 2 to 3 months. So I said to them, look, you'll eventually get into the WTO and join that global system, but that's only half the game. Why don't you do what China has done? Take this small APEC economy, New Zealand, and create your first FTA. And to my astonishment, they said yes. So 2 years later, it took a long time to negotiate. I'm up in Moscow. I do a deal with an outstanding Russian intellectual, Ulyukayev, who's now in jail for 8 years on trumped-up corruption charges by President Putin. And I finished the negotiation in Moscow, and I texted the Prime Minister, John Key, and said, do you mind if I miss the cabinet meeting next week because I need to be here for a signing ceremony? He texted me back and said, no problem, congratulations, see you on your return. So I went out partying in Moscow with the ambassador and his team, didn't read the news, and on Monday morning I turned on my iPad to find that the lead item in the New Zealand main media was Prime Minister orders Trade Minister Grosser to return from Moscow immediately. And I'm thinking, well, what the hell has that got to do with his last instruction? What I did not realize was that they had, in the previous 48 hours, started this process of dismantling the Ukraine. And it was obviously, in both the Prime Minister's and eventually my view, not going to be a good look if a small Western country and member of the Five Eyes arrangement was seen in Pravda front page, smiling, signing Russia's first ever trade agreement with an APEC economy after they had done this. Now, I think we need to understand that that process of integrating Russia into the global economy via both the WTO, which took them, I think, 12 years to negotiate their way in there, and then eventually into APEC and the agreements that are sort of associated with the APEC framework, is part of the broader picture we're debating today, which is the post-war global era. And we shouldn't forget, for example, that the resignation of the pro-Russian president of Ukraine in 2013, I think, was early 2014, Yanukovych, was actually sparked by his refusal to sign a comprehensive trade agreement with the EU. So I'm not the only analyst that is commenting on these terms. There are sort of essentially three pillars of globalization in the post-war era. One is respect for sovereignty, and in particular, no attempt to redraw the lines of boundaries established after the war because it has trapped ethnically comparable people behind different political configurations. The second was to enforce peace through US-led deterrence and security agreements. And the third was inside each sovereign country was, a movement towards respect of human rights, peaceful transfer of power, democracy largely defined. So all of these things are part of the post-war global era, and they're all under pressure. And my story about the collapse of this FTA is, I think, a sign of the times that we are under. And I'm very concerned about it, Stephen, primarily because I'm a great devotee of Robert Kagan, the so-called neocon, although I don't find that label particularly revealing, whose recent book about 2 years ago, The Jungle Grows Back, the very title suggesting globalization, is slowly under massive pressure. And fundamentally, it all comes down to the United States. All of this was underwritten by the massive relative power of the United States. As Kagan points out in many of his writings, liberal ideas have been around since the Enlightenment for centuries. The only reason they succeeded after the catastrophe of two European-initiated wars in the 20th century was because for the first time they had massive relative power to enforce those liberal principles. And now we see the United States in real trouble. They withdrew from TPP when I was New Zealand ambassador in Washington. I witnessed that disaster of American policy. They are occupying essentially an empty seat approach in the WTO, and I spent 11 years of my life in the WTO and the GATT before that. And I think we're under a lot of pressure, frankly, on the institutional frameworks of globalization. I think it's not about to collapse. I could elaborate on that if you're interested. But I do think we need to recognize that we are living in very uncertain times. And I'd like to finish my introductory comments by referring to a quote that anyone who's ever been a student of globalization will have come across. It's a very famous quote from Keynes's brilliant polemic, The Economic Consequences of the Peace, when he said something like, I don't have the quote in front of me, but an English gentleman, could, prior to the outbreak of World War in 1914, sit in his bed and drink coffee from plantations in Ceylon, order more investments in Argentinian railways, and so on and so on. In other words, the pre-World War I globalization era. And of course, it all came down to a shattering collapse as the consequence of war. Because at the end of the day, globalization is a political construct. Yes, it's driven by technology and by profit maximization and the search for business opportunities. But it runs through the arteries of certain political understandings, keeping a global trade and payment system open. And they right now, Stephen, are under a lot of pressure.
Okay, thank you very much, Tim. We'll come back and address where they might go with the Russian invasion of Ukraine and what might happen next. And in fact, our next guest may comment on that as well. Rodney Jones is the principal economist and analyst at Wigram Capital Advisors. He has a long history of working in China for a range of clients and has been a China watcher for a long time, but I also understand has much broader knowledge of the geopolitical world as it relates to business and economics. Rodney, thank you for joining us. These are indeed strange times. What's your current take?
I've spent the morning revising, or since 4 a.m. Ukraine time yesterday, revising what I was going to say. Like what Tim Grosser said, that Keynes quote, I come at globalization as an economist. And again, look back at that 1870 to 1913 period where you had free movement of capital, labor, and goods. And that all came to a crashing end in World War One. And then, part of the reason the UK went back on the gold standard in the 20s was to try and recreate that world. In a sense, we're in a similar position now. That's what framing we've been thinking in terms of, and the pandemic represented that sort of break. Now it appears even, that seems a bit trite given what's happened in Ukraine in the last 24 hours. And so it kind of reminds you of that Hemingway line that you go bankrupt two ways, slowly, then suddenly, or gradually, then suddenly. And that has been the path of globalization. It's been this slow unwinding, and it was fascinating to hear the story from Tim about Crimea and New Zealand's FTA, because living in China at that time, that 2014-2015 period was a key turning point in terms of the South China Sea, the rise of Xi Jinping, the move away from collective leadership, and that culminated in 2017 with the end of term limits, and Xi now this October, or in all likelihood, are going to have a third term. And so what we've got is now we've got this accelerated downward shift in globalization. I'll come to some of the domestic economic factors that are working in China. But first of all, I think because of what's happened, we need to turn to kind of Russia, China. And I think when the history of this period is written, February 4 will loom as a large date. And I think as a small country like New Zealand, that's a very challenging, what's happened is extremely challenging. And that was a joint statement from between Putin and Xi Jinping. And where two things stood out from that. They're friends with no limits, and there's no forbidden areas. Well, within 3 weeks, Putin has tested that new definition of friendship. There was some hope yesterday that Xi had been caught off guard by this and that we would see some commentary from the Ministry of Foreign Affairs in China. Unfortunately, when Wang Yi spoke to Lavrov, he kind of affirmed that Russia was acting on legitimate concerns around security. And so this means today, and I've always never done this in public, so this is the first time I've spoken in public on this, is that we do need to now start talking about Taiwan. But in some ways, the joint agreement and then immediately followed by an invasion of Ukraine establishes the cause belli from China's perspective. And so this is, somewhere where, we haven't wanted to go, that we're going to have to start thinking about those dynamics. And that's something new. But for right now, that's still in the future. But it's a new factor in the equation that I've tended to downplay myself. Domestic factors have been really important. There's the factors around the economic policy in China that we associate with kind of diminishing globalization, and that's common prosperity. We've seen the clamp down on the tech and property sectors. I tended to remain quite optimistic until early last year that China could still grow fast, even with this shift towards common prosperity. That's now misplaced. So we've kind of got the market in retreat in China and the state-owned enterprises on the march, and the state with that advancing. So we've got internal dynamics in China that means it turns inwards. And as Gigi kind of referred to, COVID has had this turning inward effect in a lot of countries, including New Zealand, Australia, but particularly in China. And the zero COVID keeps that in play. We now have an opportunity to kind of exit our policies over coming months. In China, as we see in Hong Kong, they're doubling down on zero COVID. And what we're seeing in Hong Kong, just a brief comment there, they've used Sinovac for about half their vaccinations, and it looks like it's completely ineffective on stopping transmission, and maybe less effective than previous studies have suggested. So Hong Kong is looking at very high death rates. Hong Kong University is talking about 7,000. Our modelling suggests 10 to 15 is possible, but certainly Omicron's going to spread and is likely to spread into the mainland. And so we've now heading ahead in China to a year dominated by COVID policies, by zero COVID, which means we have another year of turning inward. So it's a lot to absorb, but that's my initial comments.
Thank you very much, Rodney. Thank you to all our panellists for that initial comment. So we're doing a sort of a bit of a stock take. Listening to the three of you, one thing that's quite apparent is the absence of US leadership in this most recent period in different ways, and particularly around the world order, the WTO, for example, and you'd have to say in the last 24 hours, I mean, completely understandable that they're not rushing to go into Ukraine, but again, a sense of US impotence, and I sit there thinking about that and thinking, well, gosh, Russia's about the 12th largest economy in the world these days. It's smaller than Italy. It's not much bigger than Australia economically, and yet here they are thumbing their noses at the world, and so the question really becomes, I suppose, has the West lost its mojo? And I'm not meaning that in terms of militaristically, but just in terms of economically, in terms of its sense of direction, and where are we going with this over the next little while? Where's global trade going? Are we going to see a reduction in trade, or particularly in services trade, or is the West in a position that it can recover and reassert these what have been global norms ever since World War II? So there you go, Gigi, just a quiet couple of questions. Your thoughts?
Well, I mean, we certainly have seen in the last 2 years a significant reduction in services even within countries, not even covering between countries. I think that the opportunity exists for countries that see the writing on the wall to actually move proactively to try to reignite and reactivate their comparative advantages in the global economy, which still exist. You know, it's still true that Australia just is going to have a comparative advantage in natural resources. It is going to have a comparative advantage in services within a Western English-speaking environment for people who want that. So, that doesn't go away. The economic realities don't go away. And I did study a bit of politics in school, but I am very much consummately an economist. And so I'm thinking about opportunities from that perspective. And you see this being, taken advantage of already in places where there have been reductions or elimination of restrictions. Florida, Texas, obviously Scandinavia, these places are, they've dropped restrictions, or they, even a long time ago, they dropped them. And you can see just from the demographic movements in the United States that does lead to more economic prosperity. The Californians are moving to Texas. Why? Because it's better for business and it's better for life there. So if Australia and New Zealand really want to be on the front foot and capture what remains of the goodwill for global trade and movement of goods and services and growth and human welfare, then that's what they should do. That is the opportunity. So use this as a reason, if you need one, politically, because that's been the problem for more than a year now. Is politically, it's been impossible to extract, the story from COVID and focus on something else. But use the Ukraine situation or something with China or whatever as a reason to reject all of this madness on COVID and refocus on what is actually good for New Zealand. And that doesn't just mean limiting numbers of people who die from COVID. So I think that's the opportunity. And I do think that we are going to see a continued long tail of the cold shower effect from the kind of inward turning, as I think Rodney put it. But we can try to push against that, and we should.
And globalisation seems to be in retreat currently. But do panel members, and perhaps I'll bring in Tim and Rodney, do you see that as transitory, or are we seeing a fundamental shift now in great power politics, which really New Zealand rides along on the way? We don't get to influence that a lot. We have to sort of cope with whatever happens. How do you read it, Tim?
Well, first of all, going back to the Ukraine, I mean, we're all familiar with the law of unintended consequences. And if any situation merits application of that principle, it is war. So I think, as I thought Helen Clark's comments yesterday were absolutely on the money. The Russians are probing the boundaries of the Western powers. And what will actually happen is extremely difficult to forecast with even slight confidence. I suppose if pressed, I would say the most likely end game is the installation of a puppet regime in Kiev, but it won't stop there. And the consequences for Putin himself in the long term could be disastrous. We just don't know where this is going to go. Going back to the broader framework, I mean, globalization is, putting aside COVID, my own, I don't want to elaborate on this because this is not my field, but my own view is that we're at the beginning of the next phase in management of COVID, which will involve, in fact, dismantling of all these restrictions. It's just that this needs to unfold over time. It's already started in Denmark and other places like that. It will happen in Australia and New Zealand. We're just 6 months too early on this point. So we'll get back to living with COVID. And then we confront this central problem you've raised, Stephen, which is globalization. I mean, globalization being smashed by COVID, but when that is then just part of the background noise, as it will be in my view, where do we go? Well, the first thing, it goes back to my point about American power. The globalization period since 1945, as I have argued, like as a very conventional view, rested on massive relative power. And what we've seen is the rise of an alternative power center, mainly China, that does not accept many of the underlying norms. Well, I thought they did, but the situation has changed dramatically. You mentioned Rodney Wong-Yi. I still remember going up to Beijing to have discussions with Wong-Yi when he was Minister of Cross-Straits Relations to clear the lines for me to begin a negotiation of a comprehensive FTA with Taiwan, using, of course, the Chinese Taipei title. And that went very smoothly. We were able to do it. Trade with Taiwan has gone through the roof as a consequence of it. But that window, that was we took advantage as a small Western country of the high point of globalization. No question about this. Situation since then has gone backwards. Question is it perpetually in retreat? And the answer to that can only be, well, the old phrase, predictions of my death have been greatly exaggerated. Don't fall into the trap of predicting the end of globalization, because there are massive technological and economic forces to hold many of the achievements in place. And if we look into my area of specialization, trade policy, that is absolutely the case. So after the disastrous decision of the United States, Trump, I was sitting on the floor of Congress when he announced it, and it was an astonishing sight to see these US politicians respond to him with complete stunned silence. But Japan, Canada, Australia, New Zealand, and the other members have kept that show on the road. United Kingdom, which is the 6th largest economy in the world, will end up joining that. Of that, I have zero doubt. Korea will be next in. So with respect to the WTO, that's more problematic and far more important than CPTPP, because it controls roughly 60 to 70% of global commerce. We're now testing the limits of what used to be called the bicycle theory of international trade, which posited that protectionism is a little bit like a bicycle. It either moves forward or it slips backwards. But actually the analogy is wrong, because there are many trick cyclists who can keep this thing wobbling in a stationary position for some time. And that is essentially what is happening in Geneva. It's done nothing in the last 20 years, but it has not gone remarkably backwards, except with respect to the United States withdrawal from the dispute settlement process. So I think we should not be overly dramatic about this. I have no doubt that we've seen the high point, at least in my professional life, of globalization. But it's not going to suddenly all fall away, because there are very powerful technological, economic, and political forces trying to hold on to what it has achieved.
Okay. Rodney, your view.
So Xi Jinping uses this line, the East is rising, the West is in decline. But as Tim says, that underestimates the resilience. So yes, we're past, I quite like that framing, we're past the high point. I mean, rather than saying it's the end of globalization, that can globalization survive China turning inward? and then Russia. But, Russia is less important economically than geopolitically. It's China that matters economically. And so can globalization still survive China turning inward? And it's going to be tested. Global imbalances are going to worsen. As the private sector struggles in China, we're seeing exports rise and China's kind of structural imbalances, large surpluses come back. So we've got big tests ahead of us, particularly, what happens to Chinese growth this year and next year, what happens with zero COVID. China's run a good surplus and a services deficit. Now that services deficit has shrunk as they don't travel for education, for holidays. It's impossible to go there to sell your services. So we can get back to somewhere, but for now in 2022 and in 2023, the choices that Xi Jinping makes, what happens in China, is in some ways more important than anywhere else. And so, the long term is always difficult. I prefer to focus on the short term. And what we see right now is that China's turning inwards, turning away from globalization. It's not over. And the question then is, what happens in Ukraine is important. What happens to Russia? And then also what happens with China's zero COVID policy? Does the economic cost, the social cost of that become too high? So I used to say that I was a short-term pessimist on China and a long-term optimist. I'm much less optimistic long-term, but that's conditional on Xi Jinping staying on this track. If we can see a change, then better things can happen.
So Gigi, taking your point about New Zealand and Australia getting back to their competitive advantages, of course what's been going on is that through this period, commodity trade has really kept both countries on their feet, and particularly Australia iron ore, but also to China, right? It's China that's underpinning. In a funny way, I remember as a minister 5 years ago being told we were way too dependent on China and way too dependent on dairy. Well, hello, today we're a lot more dependent on China and a lot more dependent on dairy. So from your perspective geopolitically, and Australia's had many more run-ins with China than we have diplomatically in the last year or two, do you see the bigger risk being the China relationship for Australia, or the risk that China actually gets it wrong as they centralise control more under President Xi? The potential for things to get mucked up must be getting higher.
Sure. So, you're of course very, very right that China is extremely important to Australia economically, and that was also reflected in the other panelists' comments. But I do think that it comes down to whether or not it's actually sustainable for China to cut off one of their best sources of natural resources if they in fact decide as the party, okay, we want to build more here or build more there, right? Iron is required for steel, which is required for construction, right? That's sort of how it goes. And same thing for other kinds of natural resources. So first of all, you wonder about what's the level of production going to be of those downstream products around the world, but particularly in China, which will then require us to, require natural resources from someplace. Australia will continue to have a comparative advantage in supplying this. Now, there is some activity in Africa now that may compete with some of our natural resources, and that's the sort of thing that we should worry about. But then there's other exploration here, rare earth metals and whatnot. So I think it was what Tim was saying about the powerful economic forces, right? There are just very powerful forces in play, which come down to the distribution of resources across countries and the actual economic self-interest of those countries. I am more of the mind that Australia will continue to have those natural resources and will need to find other ways to trade with other countries, including there, but also in services. If we don't have Chinese students, we'll have Indian students. If we don't sell our iron to China, we'll try to sell it someplace else, or we'll build something here. So economics has a way of working out the opportunities and exploiting the opportunities when you allow people to make decisions freely and go where they want to go and and trade where they want to trade. So again, that restriction of COVID and the restrictions that are put in place by any centralized regime, really, where the government is saying, here's what you should do, here's what you shouldn't do, including in China, that is a huge drag on discovery of new opportunities that could replace some of the ones that have been damaged during this time, or where we feel there's less certainty about the demand going forward for our products and our services. So I am cautiously optimistic, but I agree very much that there's going to be less of a rosy future in terms of growth. And we've known that since the start of our COVID response. We have significantly damaged the trajectory that we otherwise would have been on in terms of GDP per capita. And that, of course, rests very much on our trade overseas. So we've sort of already damaged ourselves now, and now we're trying to recuperate and looking at a much less rosy future, that's for sure. But there's definitely things Australia can do and should do, and the same with New Zealand right now, that would be in the interest of the countries without doubt. And so politically, I think it's quite easy to put together a package and sell it, and just avoid the more damaging directions that some of the countries are going.
Because the world has, I suppose, subsumed economics and a whole range of other things, for good or for bad, over the last 20 years. So, for the last 20, 30 years, the world has been all about trying to make their people more prosperous, to do things collectively as a group, to try and boost trade and increase prosperity. And then in the last 2 years, or 3 years probably, you've got China hitting pretty hard on some of its sectors, sort of irrespective of the economic impact. You've had the COVID, which we've talked about, and that's putting, for lots of people can say it's the right thing to do, to put the health response ahead of the economic response, but nevertheless it's been done. And now you have a situation in Russia where there's no doubt that the economic price that Eastern Europe and Russia in particular is going to pay for this incursion into Ukraine is going to be pretty high. You sort of wonder, at what point does the world wake up and say, well, actually, we've got to actually make our people more prosperous, and that has to become front and centre again. Tim, do you think that's the sort of calculus that we've got to start thinking about again?
I don't think I can give you a snappy one-line answer to that. One of the things that's going through my mind is what impact the Russian breaking of all the most fundamental rules of stability in Europe will have on American politicians and their thinking. And it's just possible that this could be a giant wake-up call into Washington, and that in itself could become a positive matter. I just don't know. It's just there are too many uncertainties around this new game, uncertainties around how far is President Xi going to take China in this direction. Listening to Rodney, I just keep on coming back to that wonderful analysis of Professor Nicholas Lardy, I think one of the great analysts of the Chinese economy, Peterson Institute, who points out that the state-owned sector of China is the greatest drag on the Chinese economy. The total factor productivity of the SOEs is appalling compared with the Chinese private sector. So if he continues to move in this direction, taking Nicholas's title of his book, The State Strikes Back, in this direction, it's going to increase his problems and China's problems. And in the long run, the biggest issue China faces is the demographic change in Chinese data. The Chinese population is likely to shrink massively over the next 30 or 40 years. And I always remember a professor of demographics pointing out to an audience that I was a participant in that demographic projections tend to be the most reliable of all long-term projections. So we'll wait and see how that plays out. In the meantime, I do think there's a very intriguing political problem facing Australia, New Zealand, and our other partners in the TPP or CPTPP exercise, and that's the Chinese application. All of these trade agreements are not just agreements about international commerce. They're also statements of geopolitical alignment. And I find it really intriguing to think, how on earth are Australia and New Zealand going to react to this? You see, in the early discussions I had with a man that I know, you, Rodney, will, if you don't know him personally, know of him, Wang Shuwen. who is, excuse my appalling Anglo version of Chinese pronunciation, but he's an old friend of mine, and I've known and worked with him for about 15 years. And he even consulted me along with his team in Washington on what on earth they should do in response to Trump's ludicrous trade war on them. So during the earlier discussions, when I was the administrator of the TPP negotiations, because New Zealand's the country that established the TPP exercise, the discussion with Wang Shuwen and the senior Chinese economic officials was they didn't have a political clearance to join, but it's quite clear to me that the Ministry of Commerce wanted to join. And the really intriguing reason they wanted to join was because they wanted the disciplines on SOEs. They were well aware, as Nicholas Lardius, that the SOEs are the weakest part of the Chinese economy. And they wanted those disciplines to reform the weakest part of their economy because, as they used to say to me, the impetus from WTO reform has now run out. We need further external influence. Now, these people are still there. I don't know how this is going to play out. But politically for the United States, for Australia and New Zealand and our other partners, an interest by China in joining CPTPP is fundamentally a different political challenge to when the United States was involved in it. And I think this is going to be a real political problem.
Okay. Look, we're running out of time as always, and we've always got so much more to talk about. I do want to come back, if we can, to the events of the last 24 hours and the impact of those and how they might play out in the Southern Hemisphere. I mean, we know that it's not as immediate and large as it is for our relationship with China when things happen there. But nevertheless, we're seeing a pretty big tearing of the fabric of geopolitics and globalisation at the moment with Russia's invasion of Ukraine. An earlier panel talked about increases in commodity prices and potentially increases in inflation as a result, particularly oil and gas, obviously. What do you think are the sort of short, and are there any longer term impacts of what's happening now with Russia and Ukraine? Perhaps, Rodney, if I come to you first, and then just go quickly around the panel to finish.
Yeah, it adds a layer of disruption on our already disrupted world, as we see with supply chains, movement of goods, the frozen movement of services. So it is a real shock, and it will add to inflation, and particularly for Europe, it's a classic supply shock that will diminish growth. So it's going to take time to work through this, what it means. If there's one glimmer of optimism from this discussion today, it's that maybe Putin has sped up the process. Maybe the invasion doesn't go as well as he hopes. Maybe in the end there's a backlash within Russia and even within China that this is the wrong track to go down. And so, maybe things can happen faster. And in 5 years, we find ourselves in a better position than we would think today.
So I think basically I agree with the analysis that there's going to be probably an impact on prices overseas, and of course if commodity prices go up, that's good for Australia potentially. It depends on what commodities we're speaking of, but we've been worried about inflation anyway for a while now because of the signals in the US and elsewhere, and so it's really just a question of how long it takes to propagate through the supply chains and come here. And we have had a lot of fiscal stimulus, and I think New Zealand has also had that because of COVID. And so that gives sort of the capacity of prices to actually rise because people have the spending capacity. So I am a bit worried about inflation going forward, which would have other effects on the housing market. But just to see things in perspective, the kinds of effects on dampening effects on global trade that we are seeing or may see because of this incipient and now happening war are really small in comparison to what we've done to ourselves over the last 2 years. Again, just to keep it in perspective, we have kicked a massive own goal, not just here in the Antipodes, but overseas as well, many places. And so to focus now on one particular event, it's sort of like saying, gee, the Canadian truckers, stopped trade over the Ambassador Bridge, and isn't that horrible because it's disrupting supply chains and everything? Well, that's exactly what we did, that what the politicians, the leaders of countries all around the world did for many months, if not years, during the COVID period. So keep perspective on what's happening. And also remember, all politics is local. Australia and New Zealand care about what's going on in their backyard, and our political choices are going to be reflective of what's important to Australia and New Zealand. And, as much as it's sad and dismaying to see this sort of tearing of the geopolitical fabric, as Rodney said, in Russia and Ukraine, it's just not that relevant to the guy on the street in Australia. And so what's relevant to him is, can he keep his job? Can he feed his family? Can he see his children thrive? Can he take a vacation in Bali, etc.? And so the best move for the politicians, again, is while things play out overseas, as they will, and there may be some ups and downs in commodity prices and general willingness to trade with other countries, try to do the best that he or she can in his own patch. And that means, again, lifting restrictions, getting back to normal as quickly as possible. Oh, and by the way, if people want some information about that, this is my new book, a reasonably new book about the COVID period. Just have to give a plug. It's available on Amazon. And it does talk about how there isn't a health economics trade-off. Economics is about health. Economics is about providing an opportunity, a platform for the creation of human longevity and well-being. And the policy response we've seen during COVID has not been good for health.
Congratulations on being the panellist across the 2 days who's been able to get through the most naked plug of their book. Well done indeed. And finally, Tim, last word for you, just very briefly, in terms of the impact on New Zealand of what's playing out at the other end of the world.
Well, the first question would be, what will be the direct trade impact? Sanctions will be imposed, but it's important to remember that our total exports to Russia are a tiny $200 million. That's about 1% of New Zealand total global goods exports. And in any event, it is highly unlikely in the past, when sanctions have been implemented for political reasons, almost always food has been exempted. So I think one can move immediately to say that the front of mind thing of the media will be, what will this cost if New Zealand joins in sanctions, as we will join in sanctions, I've no doubt about that. Will be absolutely minimal. You wouldn't even notice it. The bigger impacts economically will be through the subtle impacts on the price of oil. Is now, I think this morning, reached 110 in the futures markets. This will add further to US inflation. This will influence decisions by the Fed as to how quickly they want to move on the federal funds rate, and therefore what the outlook for global inflation will be. So I think this sort of the indirect economic impacts are going to be vastly more important than any immediate trade impacts. But, you'd need to have a separate discussion to try and put numbers around that. But certainly far more important. The bigger issues for New Zealand really will be political, and I think we've covered those issues.
Great. Thank you very much to the three of you. Tim Grosser, former Trade Minister, Rodney Jones, Principal Economist at Wigram Capital Advisors, and Gigi Foster, Professor of Economics at the University of New South Wales in Sydney. Thank you all three for joining us today and wrapping up our conference program. Well, Matt, it's been a busy day or two, and of course playing out in a geopolitical environment which is very dramatically changing.
Yeah, it's happening live. I think you and I have discussed in the past. I'm reminded I was in Kiev in 2004, late in that year, when of course there was, this is not a new conflict, and the relationship between Russia and Ukraine, of course, is spanning centuries, but I remember waking early, walking through the empty streets of Kiev, which we've seen on the media today. That was just at the time of the contested election between Yushchenko and Yanukovych, which was again a part of this tension between Ukraine as a Western nation, or Ukraine as part of the wider Russian sphere. I know you've been up there yourself. It's quite amazing and very sad, obviously, to watch all of this play out and see the scenes there. So I guess it adds a note of realism to all of the other discussions we've had. Look, I've been amazed at the panellists we've had on over the last couple of days, covering so many topics. We said at the start any one of them could have been exploded out into a couple of days worth of discussion. We're a skimming stone. We're only able to touch onto them lightly. I've got some views, but what have been some of your biggest themes over the last 2 days?
I think just in some ways, actually, in the last 24 hours, particularly since the invasion in the Ukraine, just how challenging it is for policymakers to make sense of everything that's happening at the moment. And you've had COVID, you've got suddenly inflation, which, as somebody pointed out to me today, half of the workforce has probably more, has no personal experience of. Another person said to me that, graduates from this school and other schools that will be going to work in Treasury will have had absolutely no personal knowledge of inflation and the detrimental impacts it has on everybody and in particular lower income people. So you've got sort of history cascading in on top of a range of events. And so to me that sits out. It's going to require cool heads. I think it is also going to require a focus on economic activity again. There are entirely reasonable reasons why all these things have subsumed the importance of economic activity in recent years. But if we don't get back to helping people grow their incomes, improve a lot of their families, and succeed in their own lives, then actually we'll see more geopolitical unrest around the world, because there's a whole lot of people that are getting pretty impatient with the way things are. So I think for policymakers here and elsewhere, we've really got to get back focused on what makes people more prosperous, what helps them get ahead. And I think there's a bit of that that's been missing. And in some ways, the debate has evolved in the last 48 hours. I think you said it, that that what's happened in Russia and the Ukraine has suddenly put some pretty cold hard realism over some of the policy discussions that have occurred in the last few years that don't seem to have gone particularly far.
Yeah, it's a striking and difficult event to grapple with. But so there were two or three things that you mentioned there that have been on my mind too, listening and observing so many of the panellists we've had. The first I had was actually a shared aspiration. People are looking for the same things. It is thriving businesses, thriving society, thriving natural world. That's what Waikato Management School is all about. And the disagreements come, of course, in how you get there. So, okay, that's easy to say. I really took from Helen Clark's talk yesterday this notion of preparedness. This is a complex, interconnected world. Every session we've had has interwoven into every other session. Housing is connected to monetary policy, globalisation is connected into everything else. All of those are connected. It's a lot going on. So when I look at that, the quality of analysis, the rigour that's being applied, we heard Jim Bolger yesterday challenging people to think more boldly and yet do the hard work, do the homework to see how are these policies going to work together. That's come through as a huge theme for me. Yeah. We need the bold thinking, but we need to be very careful because there have been a few punts into the dark. I recall one.
And we heard about it. We've been hearing about that. Some of the policy analysis and then execution risk is pretty high. And there were some points in the last 2 days where you didn't get a massive amount of confidence that the work had been done. And we talked about the Kiwi number 8 wire mentality as it applies to policy making, and it's not tidy. So we do need to improve the rigour of some of these decisions. I completely agree. I also wonder whether we're seeing some of the debates overtaken a little bit. So, for example, the debate around housing, which I know is a particularly big issue, but I get a little bit of the sense that we're still rehearsing the arguments, the pre-inflationary arguments, and now we're moving into a period of quite high and growing interest rates, potentially relative to where we've been. And that might change the whole discussion around housing, I suspect. So it's a very fluid time. It's a time of some pretty quick changes. And I think the great thing about this is we're having a discussion and people are actually being encouraged to come up with different views. And that was really the real positive of Jim Bolger's, I think, contribution yesterday, which was, let's just think up some new ideas and let's have a crack at them and think them through. And I think hopefully we've started that process over the last 2 days.
I agree, thanks. I'll wrap us up, but I think it's a good place, and it's where we began. Actually, when we started the New Zealand Economics Forum last year, our intention was to bring together people from lots of different backgrounds to debate. We're not seeking consensus here, we're seeking informed disagreement. rigorous analysis, vigorous debate was the motto. We need it more than ever. And so that's absolutely critical, and we wanted to provide a forum for that. I think my last observation is, and particularly from the panel that we've just heard, the overlay from the sort of clinical economic arguments and the overplay of politics in all of this. You know, what are the national stories, and you certainly see that in Russia and the Ukraine, but that political overlay on all of the topics, and I think, you know, there'll be plenty of opportunity to weave that in for next year. And speaking of next year,
yes.
So we will wrap up the conference here. It's been a great 2 days. Again, a huge thank you to all of our presenters who have joined us over Zoom. Next year, we hope, of course, to welcome you here on campus. Thanks to all of our moderators who have joined and facilitated the sessions so well. Thanks to you, Stephen, for joining us as our special guest and engaging in this, and to all of the crew and the team behind the scenes who have put on an event for us. Moving our minds to next year, we will be back with the 2023 New Zealand Economics Forum. We hope to have that on campus. There's a fantastic new facility, the PA, being built about 500 metres from here, a really flagship building for Aotearoa New Zealand, an amazing facility. So we look forward to seeing some of you there. In the meantime, we'll no doubt be watching the news as it unfolds for the rest of the day. There's a lot of debate to be had. Keep the thinking going, and we will certainly be seeing you for more discussion and debate in 12 months' time. Ka kite.
Tapatapatu ki te rangi whakaea kauana. Kei runga te koti pū, kei raro te koti hono. Ki kona koutou mihi mai ai tangi mai ai ka mau te hono. Whiti tū, whiti ara rānea te rangi e tū nei au ake, rānea te papa e takoto nei au ake. Whakahonoretia ki ngi tū heitia pōtatau te whero te tuawhitu nau mai ki te ware wānanga o Waikato.
In the heart of its Hamilton campus, the University of Waikato is building an innovative and versatile new facility. Designed to transform the on-campus experience for students and the community, the PA will be an all-seasons hub for everyone. In a prime location on the campus, the PA provides a new gateway to the university. Across an expansive marae ātea, the face of a new university wharenui will provide the shape and inspiration for the broader complex of the PA. The wharenui will embrace the history, heritage and mana of Waikato, Tainui and the Kingitanga. This will be a premier space for teaching and learning and a place of mana and pride for the university. Along the northern face of the PA, the central campus walkway leads from the marae to the student hub. With spaces tailored for socialising, resting and recharging, the hub will be the year-round home of campus life. The generous central atrium incorporates a selection of food retailers, breakout spaces, social spaces and meeting rooms throughout, extending to the Faculty of Māori and Indigenous Studies and senior leadership space on the upper level. A large stage will host performances and events including student welcomes, graduations, celebrations and other university and community activities. The lift tower and bridge will connect the upper and lower levels of the campus, improving accessibility and mobility across the university. The PA is the largest capital project in the history of the university. It represents our commitment to students and student learning, to innovation, distinctiveness and to a transformative campus experience. With its diverse spaces and multiple functions, the PA will be an all-seasons campus destination for students, staff and the wider community. The PA, it's for you, for me, for all of us. Māku, mau, mā tātou katoa.
Thank you.